we start, good morning to everybody. I hope you all can hear me well. Hello. Just tell me if you can't. Just one or two people acknowledge that. Great.
It describes like, well, what are the things we can hear. Yes,
Okay.
it was clear.
Okay. Very good. Okay. So then I'll just recap on a few things from last week. Not recap in the sense I won't go through the whole presentation because we won't have time to do that. But basically, today we have around three presentations, three slide sets, but they are not too complex. And I feel that we'll be able to go through it. If we are not able to, we might just have one of it that we do for the following week beginning or the week later on. I'll have to speak to Nishanta about it and just coordinate how we manage that. But just to recap from last week, we basically touched mainly about liquidity management and how liquidity management and what the role of Treasury is in liquidity management. So basically, we touched on areas like what is liquidity versus profitability. We went into deep about that. We touched into how liquidity has an impact on the bank and how important liquidity is even versus profitability, what the impact is. We went into gap analysis and what positive gaps are and negative gaps are. We looked at the different strategies for managing liquidity that the banks have. So, for example, capping, like I said, net or FX positions and how a bank would hedge its capital if it were to invest in one of its, say, branch officers and how they look at it and the different capital hedging methods. We look at how liquidity impacts a bank's creditworthiness and the other way around as well. And then went into detail on how a gapping position is taken, what a positive gap is, what a negative gap is, what a bank should look at when they are deciding on a positive gap, what a bank should look at when they are deciding on the negative gap, how a bank should be aware of the market situation also when deciding on their strategies in terms of views on interest rates, views on liquidity availability, etc. And then based on that, have a strategy where it remains liquid and while remaining liquid, generates a profit for the organization as well. So a very important thing to understand is liquidity management through a treasury function is not a cost exercise, or it's not a simple regulatory requirement or a requirement to tick a box in terms of that you have met your commitments to your shareholders. It is also a way of make sure generating income. So for that, you have to be very aware of what the situation is around you as well. Any questions from last week? I think we went into detail last week quite a bit on that slide, but if there are any questions from last week, happy to take it. I have a few minutes I can give you for that. And then we can jump into today's presentation, today's area. Okay, so today we basically go into three areas. Basically, one area would be the structure of treasury, and then basically second area would be first area we're looking at, will be treasury as a cost center. Second area we'll be looking at is the structure and organization of a treasury sub-function. Basically, areas 4 and 5 are more or less connected. And the last area is control of dealing. So basically, I think it's more to do with, Ruchir was just telling me he was in the audit function, right? So it's like that, this is more relevant to people, why we control and how we control the risks that a treasury function would have, internal and external, how that is controlled through that. So the first one, I think we've gone into it a bit with the other presentations we've done in as well, but more or less, it speaks of treasury as a one second. as a profit center. Yeah. At the end of this session, what we want to understand is, we've already done this, but we have to recognize what Treasury's position in the bank is, where it sits in the whole bank's organizational structure. Identify the tools used by Treasury to achieve its goals. Recognize the objectives of transfer pricing rate. We will come to that. Identify uses of a transfer policy rate. Again, we will come to that. And again, recognize the role of Treasury as a profit center. I'm emphasizing that because it's important to understand. Sometimes it's confused the Treasury because it's not necessarily always client facing, or not necessarily always a function that would be seen by the outside market. That it is not a profit center, it is another function that supports the other functions to exist. Partially that is true, but the important thing to understand is that while doing that function, and I'm repeating this, it has to achieve a profit motivation as well. So it is not merely a function that supports, it is a function that supports and creates income for the bank. So basically, we just go on to slide number 4. So in a very simplistic form, if you look at where the Treasury sits, and if you look at it from a funding perspective, or borrowing and lending, which is the traditional role of the bank, as we have discussed in the first session that we did. Basically, what does a bank do? We discussed. It takes deposits, it keeps those deposits, and then eventually lends those deposits out. Now, if the bank was doing this throughout many years, and it's a very simple branch. So, for example, you are a branch manager sitting in a just one bank in one branch in some village or some town somewhere. You will tell your townspeople, "Can I have your money?" You take your money, the money that the townspeople come and deposit. You pay them interest for that. And then somebody else comes and asks you for money, you will lend that money to that person. So you are the only person in the bank guy in the town. That is a very small town. Everybody knows each other, everybody in that town. So you know when you're lending, who you're lending to. When you're borrowing for somebody you are borrowing, you know very well. So it's a very simple structure. In that case, that guy is everything. He's the guy who takes the deposit. He's the guy who's the lending officer. He's the guy who's the treasurer, because he knows he borrows at 7%, he lends to that guy at 10%. He knows he's making a 3% margin. 3% margin represents his liquidity costs, his credit costs, his everything. So in a simple function, simple structure like that, it is very easy to manage the bank's risk. Now, as the things get more complex and complex and complex, you realize that managing that in between, of taking the money, lending the money out, of managing the various requirements that we have discussed, liquidity, ratios, reserves, all these things, is a very complex situation. And there are millions and millions of deposits coming in, and then millions of requests coming. So you need specialized people to generate the income funds. You need specialized people to lend the funds, and you need specialized people to manage the in-between functions of those two areas. So that's where Treasury sits. So basically, in one way, from a funding, now this is only talking about funding. So just to deviate a little bit and give you some flavor in terms of how it works, Treasury is mainly about funding. If you look at, and some of you may know this already, a function called global markets. So there are a lot of functions now that are called Treasury and global markets. Global markets usually refers to managing the risks coming from market activities such as foreign exchange movements, interest rates movements, commodity rate movements, and generating profit by doing that. Treasury usually is considered part of the bank's balance sheet management, ALCO, and funding management program. So in our world, when we say Treasury, we include all of that. we include the global markets bit, we include the funding bit, everything sits within what we call treasury. But in a really, if you really drill down to a treasurer per se is a person who manages the funding requirements and funding risks of the bank, basically. So basically, it sits between the funds in, funds out. People, very simple. Slide number 5. Yeah, so like I said in the beginning, theoretically, because of the fact that it sits between the branch and the lending rate, or the deposit collecting arm of the bank and the lending arm, theoretically, it could be an internal function that has no contact with the market. So basically, sits there, somebody gives the money to him, then he decides and sends it out to the guy who's lending the money, and that's it. But in reality, the treasury guys can also decide on the best way of deploying the funds they receive and the best way of raising the funds they would like to deploy. What do I mean by that? If I say the treasury guys can also decide, the treasury function can also decide the best ways of generating money and the best ways of deploying money. What does that mean? If it's sitting in between, how can it do that? If it's not the deposit collecting arm, or if it's not the lending arm of the bank, which faces the market, how can a treasurer intervene like that? Any guesses? You're there, right?
Treasury can
Let's see whether you're sleeping or you're up, or so you'll have to answer me. How does a treasury? How do you think a treasury can actually decide for themselves, or what can they do when they say that they don't have to rely on those two areas necessarily to place funds or receive funds?
treasury, of course, treasury can come up with new what do you call new strategies, new products where people can attract for the particular product.
That's right.
Something
That's right. Exactly. And then what does it do when it comes up with those products or tools, as you say? So let me go into that. Let me explain. So, for example, if you're collecting deposits from a depositor at say 8%, or say 10%, and then your lending is at 15%. So, okay, fine. That you have a 5% in between. You keep your liquidity requirements, SRR, all those things, all the costs involved. You still make, we say, 2 to 3% margin. Fine, all good. Then suddenly the treasurer decides, because he's in touch with the market, although he doesn't face clients and he doesn't face clients on deposits and lending side, it does face the interbank market. It does have a feel on where interest rates are, because they're dealing in products that are very much in that. He realizes that he can raise deposits from a, we'll say, debenture or a commercial paper, for that matter, at 7% or 8%. Without going and borrowing deposits from a client. And it could be more tax efficient for the bank. It could be more capital-wise more efficient for the bank, all that. So he decides, okay, fine, let me go out there and raise these deposits at commercial paper at 7%. Now, the treasurer does have a mandate to issue securities like that. Of course, it has to go to ALCO, and at ALCO, he said, look, we're raising deposits at 10%. I don't think that's worthwhile. I'm going to use a commercial paper market, and I'm going to raise X amount of money at 7%. And then he will raise that money at 7%, and he will give it to the lending guys who are lending to clients at 15% at whatever the transfer pricing rate is. Now the lending guys can look at that as, oh, the treasurer has managed to raise money at 7%. I don't need to lend at 15%. I can probably lend now at 13% to my clients. That's up to him to decide whether he wants to bring the lending rate down. But he's theoretically getting a lower cost of funding because of the fact that the treasurer has gone and generated these funds cheaper. Yeah. In the same way, if the deposit guys are generating deposits at 10%, and look at the other side of it, and the the lending guys are lending at 15%, the treasurer can come and say, oh, okay, you're lending to your corporates at 15%, but you know, I have a AAA rated corporate debt I can buy, or a government security of some sort that I can buy. Maybe a corporate debt, not forget the government security for a second. Maybe I can lend that at 16% or 17%, or even I can lend to the central bank or buy treasury bills at the same 15%, because the central bank risk is better, so it will sit better on our books from a capital and return perspective. So I'd rather lend it to the treasury, buy the treasury bill, or lend it to another corporate, because I'm getting an effectively higher interest rate by doing that. So I'm not going to give you that. I'm going to take the money I have generated, and I'm going to basically invest it there. Obviously, he still has to make sure that there's sufficient funding for the corporate banking guys. But at the end of the day, through the ALCO process, the bank will decide the best way to deploy funds where there's a better return for the bank. So although the treasurer doesn't sit and face clients like corporate clients and retail clients, he does have a way of making sure that all the money generated and all the money deployed is going to the most efficient sources and efficient deployment in terms of the return for the bank. And also then taking into account the liquidity and all that as well. Is that clear?
Yeah.
If it's not, please, I'm happy to explain that. But that's an important thing that you all should know, that basically, although the treasury does not face clients, it has a direct say in how funds are managed within the organization in terms of even who we lend to, how we lend, and what is the best situation for the bank. Okay. Okay, so the organization chart, very simple. You have the CEO or general manager, and then you have, this is a very simplistic way of putting it, but these are the main business areas the bank would have. So for example, if you look at a general manager, CEO, then you have the corporate manager. So basically in most places, this is either called head of corporate banking or head of commercial banking, head of corporate, whatever. So this corporate manager will look at all things related to its clients, different types of clients. It could be local clients, it could be MNCs, it could be SMEs, it could be MMEs. So there'll be a branching off of the different segments here within this space. Consumer manager would basically will be the retail banking arm. So they are the ones in charge of personal financial services, retail banking. So basically branches, credit cards, anything to do with retail personal clients. Financial controller basically is the guy who looks over the CFO basically of the bank, who looks over the bank's balance sheet, and he has direct oversight in terms of the numbers that the bank is churning out. So you can see there's an important thing in this slide is that the treasurer sits independently of these groups, even the financial controller. The reason for that is there is no conflict there. The treasurer has an independent view of what the bank is doing separately, for the very reason I just told you earlier. For example, if you have a consumer manager, if the treasurer is reporting to the consumer, to the corporate banking manager, we say it this way, and then reporting to the CEO, then what happens there? This guy will want to always lend to his corporates. He will always want to make sure that he gets the best deal for his borrowing clients. The treasurer will say, no, I don't think lending to to company Y is at 15% is that efficient, because I can lend to the government of Sri Lanka also at 15%, which is a better risk for us. So we should be lending there instead of there. If he's reporting to this guy, if the Treasury is reporting, or Treasury is reporting to the corporate banking manager, then what happens is that he could have a conflict in terms of not being able to say, look, let's deploy it there. It's a bit difficult for him to do that. So that is why there's an independence in terms of who the bank will, who reports to whom. And this way, the bank ensures, the firm ensures that there is emphasis laid on the best outcome for the shareholders of the firm. Same way, the financial controller, although Treasury and finance work very close together, the Treasurer does not report here or either way around. The reason for that also is independent control. Financial controller, in a way, some of the functions within finance play sort of not a, I would say, direct risk management function, but they play a role where they have a control function on what the treasurer does. So, for example, some of the ratios managed, like the liquidity ratios and the capital adequacy ratios, are looked at from the financial control section independently. By doing that, they manage to see whether what this guy is doing is correct. If there is something wrong, or if there are numbers that are not popping up that are, look not very good, financial control will then raise it to the treasurer and say, look, I don't think it's right, and then there will be a sort of investigation to see whether this is correct, not correct, or not. So, but they, in a way, what we call in HSBC, we have 3 lines of defense. We have the first line of defense, we have the second line, and the third line of defense. So the first line of defense is the treasury. For example, in a treasury function, would be the people who look at ensuring at the first instance itself that there is no risk here, and making sure we are within the ratios. The second line of defense would be, in this case, my financial controller would look at it and say, yes, you're right, there is no risk. They would do it independently. The third line of defense is what Ruchira does, is the audit function, to see whether what these 2 guys have said are also correct. So there is independence in the way the structure of the organization is. Is that clear?
Yes.
Yeah. So, but I've just mentioned, all hierarchies, same hierarchy, not a position imposed policy to the other department. So, the same ways, basically what it's saying is that each one has its own, there is no conflict. Let me put it that way. So, just going back into what we discussed last week, objectives of the Treasury, liquidity, gapping, netting. So, objectives of the Treasury is to manage the bank's assets and liabilities. And how it does it is what we discussed earlier, last week. Liquidity, gapping positions, net exchange rate, and capital hedging. And remember, this is only talking about the Treasury part of it, which is the funding part of it. It's not talking about the global markets part of it. We'll come to that later. Okay. So how does the Treasury achieve this goal without control over the departments that borrow and lend funds? So like I said, basically the tools that the Treasury uses to, without getting involved with the borrowing arm or the lending arm of the bank, is 2 different. If you break it up into broad areas, there are direct tools and there are indirect tools. So what I told you earlier about raising money on a debenture or lending money to a different person instead of the bank's clients are what we call direct tools. You go into the market, you lend. Yeah, you go into the market, you issue corporate debt, and you borrow. Those are direct tools. The indirect tools used are more to do with how the treasurer will manage the pool of funds that he has already collected, and based on where he sets his transfer pricing policy. By using the transfer pricing policy, the treasurer can make sure that the bank is borrowing and lending at the correct rates that he feels that is optimal for the organization. So for example, if a branch wants to go out and borrow at 12%, and the lending guy wants to go out and lend at 14%, the Treasury said no. If you guys are going to do that, that's fine, but I think this is where the transfer pricing rate should be. So I am going to manage my risk at this rate, right? And then based on that, the guy who's borrowing and the guy who's lending will make a decision: is it worthwhile me borrowing at 12%, or is it worthwhile me lending at 14%? They will think twice because of where the transfer pricing rate is. We'll go in that a little bit. So, okay, let's look at the indirect tools. So we have two tools, indirect tools and direct tools. What are the indirect tools a treasury will use when trying to figure out or trying to manage the borrowing and lending costs of the bank? So, like I said, the treasurer can't get involved in setting the rate for its client. So, for example, the treasurer can't decide, okay, we should be raising deposits at 10%. No, that's up to the branch. The account officer, or in this case, the branch manager, will say, will decide. A client comes and says, I want a 1-year deposit. He'll quote 7%. He'll say, no, I want a higher rate. The account manager will decide, okay, can I give him a higher rate or not? But the account manager can only decide up to a certain level, and that level is dictated by the treasurer. So he might have a transfer rate of 8%, 1-year rate of 7%. Client comes and negotiates, I want a higher rate. The branch manager says, okay, fine, you want a higher rate, no problem. He looks at where his transfer pricing rate is and says, okay, I'll give you 7.5. He can't give him 9%. He can't give him 8.5 because the maximum he's going to get paid for those funds by the treasury is 8%. We'll go into that. So indirectly, what the treasury is doing is making sure that the bank borrows this money at the correct rate. So if you look at it, just to give you an example again, you come to the branch, you want a rate, the branch manager gives you 7%. You say, no, I'm not happy. The branch manager will take the phone, talk to his treasurer or talk to his manager, whoever, and say, look, client has a big amount of money. I think we should take the cash. I'm quoting him 7. He wants a better rate. That guy will check with treasury and say, okay, treasury says the best we can give is 8% because that is our transfer pricing rate. The branch manager then decides, okay, I'm not going to give the client 8%. Maybe I can give him 7.5 because we still need to make some cash. Okay, so he goes back to the client and says 7.5 I can give you. He cannot quote the client 8.5 because the maximum he's going to get paid, the branch manager is going to get paid by the treasurer, is going to be 8. So if he scores 8.5, he's in trouble. Is that clear?
Yes, one particular question, like when branch manager asks from the treasury, I want a better rate, what will be the maximum rate treasury can go up to? Is it go up to the transfer pricing rate, or will treasury able to provide the rate beyond that?
Well, it's like this. There are different banks that work in different ways, right? So some banks issue a transfer pricing rate every morning, which what we call, in the case of deposits, what we call the value of funds, right? So the value of funds will be based on, treasury bills or whatever the benchmark is, and the treasury will decide on whether there is a liquidity premium attached to it or not, right? So once the value of funds are issued every morning, the branches will look at that value of funds and how to know where the maximum rate they can pay to a deposit is. They know what their published rates are, but they know also what the maximum rate is for that particular day. Okay. But then, like I said, somebody comes back and asks, look, I want a higher rate, right? He knows where the branch knows where the transfer pricing rate is, but they still want to make sure they get the deposit, and they also want to make sure they can make some money. The branch can make some money, right? So at that instant, the treasurer will look at the transfer pricing rate, and if he has the flexibility, because interest rates have moved up during the day because of some liquidity issue, we'll say, he can decide, okay, the transfer pricing rate is 8, but in this case, because it's a large quantum, exceptionally, I'll pay you 9. Then the branch manager will decide, okay, I've quoted this guy 7. I was going to get 8 for my transfer pricing, but now I will quote him 8.5 because the treasury is giving me 9, and I can give the client 1.5%. The client will be happy, and I'll still make some money. So the what will happen is the decision on how much, your question was how much can the branch give the client, or what was the exact?
No. What is the maximum amount where treasury you can go up to, like?
That depends on the market rate. So what happens is the transfer pricing rate, when it's given in the morning, very rarely the treasury will go and change that. It will stay during the course of the day. However, if they are giving more, or if you are lending giving less, it will be based on the volume and the situation at that time. Usually, if it is a very large material amount, then there could be exceptions made. But generally, people will try to stick to the rates issued in the morning, basically, so that they don't have to keep changing it during the course of the day.
Okay. However, whatever that special rates made by the treasury, that need to be documented. How, like, what is the maximum?
Definitely. So if what happens in some organizer, you don't need to document anything that you're doing on a, if you as long as you're within the transfer price, it's up to the branch to see whether they want to give better rate. But if you have given an exceptionally out of the exception, that has to be documented by the branch, by the treasurer, saying that, look, this such and such a person, because of these reasons, because it's a large value, we need the liquidity, we think it's a good time to borrow, blah, blah, blah. They have to basically document that in whatever system, or, I mean, it could be email communication, it could be a system thing, whatever, but it has to be clearly documented. If not, when auditors come, even when the regulator audits, sometimes they will wonder why the branches paid such a outside of the normal deposit rates, because ultimately there's a customer fairness thing also here. If you are paying all your customers 7% and suddenly you pay another person 9%, somebody could ask the question, why did you pay that person more than in an audit or a regulatory audit or whatever you want to call it? Why did you pay that person more? Are you doing favors for that person? But there is nothing like that. The bank has the discretion based on the time. So that reason for that has to be clearly documented. That's correct.
Okay. And by that, at the same time, in the treasury documents, treasury manual or whatever the L code, that authority needs to be provided to front office guys as well. Like they can decision that also need to be documented in the sense, like.
Yes, correct. But again, I think that's like this. It's all how people want to manage it. Different places again. So what happens sometimes is that discretion is given to the treasurer. And then the treasurer can delegate certain amounts to his people working for him. So, for example, he can tell his chief dealer, you can quote up to 100 million rupees. You don't need to talk to me. You have the discretion to quote better than treasury rate, for example, right? But we have what we call, from a control perspective, what we call off-market rate controls. OMRCs. Through that, say, for example, if the market rate is 8 and then suddenly this guy quotes 12% to take the deposit, and the branch guy takes his 12% and quotes the client also 10. Now that's 4% beyond where the market rates are, right? Immediately on the following day, you get captured on terms of what we call an off-market rate check. And then the question will come, the report will go to the treasurer and say, look, your guy has paid, this much of a transfer pricing rate to this branch for this client. Right? Can you justify that, please? Is it a mistake? Have anybody made a mistake? So there is an off-market rate check that basically validates the rates the very next day. At least I'm talking from the bank I work in. I think most places would have it. But that control should be there to make sure that there is no, like what you're asking, Ruchira, there is no breach of that.
True. Because of course the special rate given, like off-market rate checks for certain products like security products. But when it comes to deposit and all, sometimes that off-market rate won't check. You mean like it's nice to have that control as well, because that
has to be there. It
Yes,
has to be
correct.
there because even if it's the control that just validates the authority given, it's not to
Okay.
say that you can't give it
Ideally, this needs to be monitored by market risk.
by market risk, by middle
Correct.
office.
Yes,
Yeah,
middle. Okay. Thanks.
back office, middle office, as some places call it, but middle office. Yeah.
Middle of. Yes.
Okay.
Okay.
Right. So then we just next one we go into ALCO. Sorry, any other questions on that? Okay. So we are going to ALCO. So ALCO is basically Assets and Liability Committee of the bank. The composition of ALCO will be the country head, the treasurer, corporate banking head, retail banking head, financial economy. So this economist, I think, is subjective. Most places don't have an economist sitting there. What happens is most ALCOs or EXCOs are the more management part of the bank. ALCOs are the more functionally driven, more to do with the balance sheet and nuts and bolts in terms of the numbers. The exco of the bank will decide on other stuff, staff issues to policies and all that overall. So the ALCO doesn't have, for example, the head of HR because there's no purpose for the head of HR to sit in the ALCO function. Yeah. But why economist? Economist could be a person who comes and presents for Exco as well as for a person who comes and presents for ALCO. Because I think it's important to understand, although this slide says economist is in the ALCO bit, I think that in certain cases, economists could be in the Exco bit as well. Because ultimately, what does economists add value? I don't think most banks have a resident economist. Most banks would get an independent economist to come in every few months. In the case of the larger, the foreign banks, of course, we have our own research arms, which basically provide us input. But if you look at most local banks, they'll get somebody to come in and sort of present the views on the economy, and not one person because they want to have diverse views. They can actually get many different economists from many different parts of the many differing views to come and make presentations and tell them at different times what they feel about the economy. So why I say that it is obviously important for all of these people in this slide because they need to know how to, position the bank. But it's also important for the exco of the bank where there's HR, where there's a marketing head and all these people there as well, because for them, also they need to understand the situation in terms of the economy to understand how to address marketing campaigns, how to address HR issues that can come up, because there is a look and feel of the entire economy when economist presents. So, like I said, what does ALCO need to do? ALCO needs to analyze market conditions and the bank's position relative to market conditions, determine immediate steps to follow, set guidelines for bank operation in terms of tenors, currencies, capping, assign responsibility for the following guidelines to different bank departments. So basically, what does ALCO do? If somebody can very simply tell me what does ALCO do?
Basically, ALCO take decisions how banks going to implement it in near future on assets and liability, when
How
it's
does it do
rate.
that? You're right, but how does it do that?
Maybe they might implement new products, they might approve
No,
certain
all that
things.
is right. All right, but how does it get to the position of recommending? What does it use to figure out what tools to use and what those things?
They might look at some reports and decide gap analysis, something like
Yeah.
that.
So it's an internal analysis as well as external analysis. So,
Yes.
for example, if we look at, like you said, it will look at the bank's own balance sheet at a given point in time, right? And see, okay, this is the amount of assets to liabilities, which is the mix of assets liabilities we have. This is our current situation. These are the currencies we have. These are the tenors we have. These are the risks we have. These are the liquidity concerns we have. These are the currency risks we have. These are even the clients we have. For example, what we discuss in terms of being over dependent on a few clients. Maybe we have a large depositor and a large borrower. Is that deposit going away soon? Is that borrowing requirement going away from our client? Do we have another way of gapping that or plugging that gap? So they will look at the current balance sheet, they will look at the current customer mix and all the ratios that we have and take the risks we have. Then what it will do is, that's the internal side of it. Then it will position itself against the market. What are we expecting? That's where the economist or somebody like that comes in, and the treasurer also comes in to say, what are we expecting with interest rates? What are we expecting with liquidity? What are we expecting in terms of policy movements from the regulator? What are the global situations that are happening that could impact us? What are our clients doing? The head of consumer, head of corporate can say, look, what are our clients doing? What is our competition doing? Yeah. Based on that, we get to this and say, okay, then let's do things this way. Based on that. Is that clear?
Yes. One particular question, like when it comes to economics role, like you mean, is it like once in a quarter or biannually? It's nice, good to have to get his view to ALCO committee, like.
It depends, Ruchira. I mean, it could be depending on each organization and how comfortable they are with the information they have. So, for example, I mean, if there are a lot of reports coming out in the media, if there are a lot of analysis already done, and the people sitting there are very conversant with what is happening, they feel that they have enough of sort of understanding of that particular economy, then probably semi-annually or even annually, for example, right? But if it's a more complex situation where there are always changing, like for example, COVID, after COVID, what's going to be the situation? What is the analysis, what people are saying? And remember, this doesn't have to be even an economist. Now, I know I have presented at different, say, multinationals who have a quarterly review from an economist, or they even get the banks to come and present to them as to what they feel is going to happen in the next quarter or next rest of the year. Now, why they get the banks? Because they feel the banks have overall view or line of sight of the whole market. They can see, what the whole economy is happening from everywhere. And they will ask our economists also to join that call sometimes and to just give their forecasted research views on certain things. So the periodicity will depend on how comfortable the company is with the information it has. If there is a doubt, if it's a volatile market, if it's uncertain what the policy situation will be and what the impact will be, they will do it. And it doesn't have to be economists coming there. They could even hire research arms to do very particular types of research for them. Saying, I want to get a research done on what customers feel about our interest rates, or what customers feel about our lending rates, and work on that basis.
Okay. Right. Thank you. And what will be the governing document for ALCO, like ALCO TOR or ALCO policy, like what will be the document?
There will be a TOR for ALCO, of course. Yes, that will be there. And that basically, ALCO will also have what we call ALCO pack, which has all these stuff in it, which is distributed every time that ALCO meets. So that will follow through on the weekly meetings or whatever,
monthly.
What you do.
Monthly.
But the TOR will be the main operating document. But on top of that, there will be like an overall guidance in terms of an instruction manual as to who sits in ALCO, what their role is, and all that. But it will be more or less covered by the TOR. This is of
Okay. Thanks.
Okay. So slide 13, we've touched on it also. So what is the treasurer's view? Like I said, he'll give the current market conditions, market position relation to the bank's position in relation to the market, suggest strategies. Like I said, you can say, no, we shouldn't be lending to our corporation, we should be buying treasury bills, right? And keep a record of the meeting and send copies to other committee members. I think that record keeping part of it, of course, can change from bank to bank. I think different people have different, the record keeping is done by different sectors of the bank. In most cases, I don't think it's the treasury that keeps the record, it's the finance guys who keep the record of it, and then basically have responsibility of formulating the ALCO pack, basically. But I don't know how it works in other banks, but I'm just saying from what my experiences are, it's usually the finance guys who maintain the records so that they have independence over what we call the businesses. The finance is what we call a support function. It's not a profit function. The businesses are basically the consumer side, the borrowing side, and the treasury side. So the finance guys would actually make sure that they keep the records of all this discussion as an independent function and share the ALCO pack with the previous minutes as to what the decisions were and how these decisions were made. Is that clear?
Yes.
Yeah, so like I said, the committee decides to recommend and makes a ban. So yeah, so you can see the treasurer plays a big part within ALCO, but I must say the other parts of the bank have an equal part to play because they have the ones who facing clients, and ultimately whatever decision made there has an impact on clients. So treasurer does have an important part to play though. The transfer pricing pool. So basically in this case, we are talking about how the transfer pricing rate is managed. So I've gone through this a little bit now already with you all. So funds in at 9%, Treasury quotes you 10%, the Department for Lending lends you at 11%. So the bank overall makes 2% on it. Basically, Treasury makes 1% here and 1% here. For basically this 9% deposit, the bank can quote 8% to its client. Lending department can lend at 13%. It's up to them. But the treasury will say, I will take your money in and lend to you at 10%. Depends on where you are. Some treasuries have a transfer pricing policy where it's one rate. So in this instance, they're talking about a weighted pool rate of 10%. But some places they will have where the treasury will borrow at 9 and lend at 10. So borrow from the borrowing department at 10%. That's the transfer pricing rate for value of funds, and lend to the other side to the lending department at 10. So basically, in other words, what is that? That is the cost of funds to the lending guys. So slide 17, we look at that. We have an asset at 9%, basically a lending at 9%, a borrowing at 8%, yeah, and then basically the market rate for a liability at 8%, basically. Okay. Yeah. So basically, the treasurer has to be very careful in how he manages his funds, because ultimately, if the branch, looking at this example again, once the money is given here and the treasury says, I'll take your money at 10%, if it doesn't lend it to the lending department again at 10 or 11% or whatever, and it holds on and says, okay, I borrowed at 10, lending guy, he says, no, I'm going to lend you at 13%, for example, not at 10. He runs the risk that this guy will not be able to lend this money to his clients, and then he'll be stuck with the money. What happens when he's stuck with the money at 10? Suddenly interest rates go down to 6%. Now, what has the treasurer done? He has borrowed money at 10. Is that a risk for him? If the department has taken the money at 9, given it to the treasury department at 10, now the interest rates go down to 6. What happens then? Who's carrying the risk there?
So can you repeat?
Yeah. So we'll say you're a branch manager. You have gone and borrowed money at 9% from a bank, from a customer.
Okay.
And then you have given it, now you have borrowed at 9% and you have transferred it to Treasury at 10.
Okay.
So the Treasury has borrowed this money at 10. Now the Treasurer decides he's not going to lend that money to the lending department at 11%. He decides he's going to lend it to the lending department at 13%. The lending department says, no, my client is not interested in borrowing at 13% anymore. He wants to wait and see what happens with interest rates. Okay. Now the treasurer has money at 10%. Suddenly, interest rates go down to 5%. What happens to the? You agree that the bank is losing money now just on that deposit. Forget about the portfolio, just on that deposit.
Yes. Yes.
Yeah, because they are borrowed at 9, right? And
yes.
Yeah. Now there's a 4% loss to the bank. Now the treasurer has paid the branch 10%. So the treasurer now, who is carrying that risk of that loss? Who's carrying that loss?
Treasury basically, but end of the day bank.
End of the day bank, yes, correct. But treasury is carrying it, not the branch. So the branch has passed on its risk to the treasury. Now, treasury has to figure out, okay, I am now on that money that I borrow, I'm losing 5% because effectively we are paying the client 9, but he has paid the branch 1%. He's losing 1%. He's losing 5% on that deposit. The whole risk sits with him. Yeah. So it's important for the treasury to make sure that its transfer pricing rate, pool rate, or whatever you want to call it, is in line with the market and in line with what clients want to do. If it doesn't place it in a proper way, there is a risk the bank will either over borrow or over lend, right? And we will basically, the treasury will lose money in the process of doing that. If the treasury loses money, the bank loses money. Yeah. Is that clear?
Yes, sir.
Okay. So basically, opportunity cost. The fact that if the treasury does not pass the funds along at the prevailing rate, it loses the opportunity to make a profit. The opportunity cost is the best investment the treasury might make with the funds in the interbank market. Like I said earlier, the treasury can decide, look, I want to hold on to this and not lend it to clients. I want to buy a treasury bill. Basically, if we don't buy a treasury bill and lend it to a corporate at 15%, okay, I'll ask you the question. If I'm lending to a corporate at 15% and I can buy a treasury bill at 15%, which is a better investment? Same tenor, which is the better investment?
Treasury bill.
Yes, because it's better credit rating and better liquidity. Yeah. So for me to lend, I'm getting the same return from absolute perspective. But for me to lend to the bank, if I lend to the corporate, I have an opportunity cost, right? And the treasurer has to decide what that opportunity cost is, where the opportunity cost is. Yeah. Then 19, if the corporate bank doesn't pay at least what the treasury can get in the market, the treasurer is better off to deal directly with the market. That is clear, right? We've discussed it already. So the transfer pool rate has to be updated every day to market condition regardless of the original cost of funds. Agreed? Is the second point clear? Transfer pool rate has to be updated every day to market condition. Is that clear? What it's trying to say is, you may have raised deposits at 8% yesterday, 9% day before. Every day this has to be changed so that it reflects the market, so that we remain, the treasury and the bank remains relevant to the market rate for in terms of borrowing and lending. So each day, the treasury could be recording a profit or a loss based on where its portfolio is. Is that clear?
Yeah, that you mean like transfer pricing rates daily basis need to be keen into the system?
That's
something
right.
like that.
So the basis of the transfer pricing doesn't change. So in other words, if we say your transfer price, but every day there has to be a change in the system, of course, yes.
Right. Okay. Is it a best practice? So, like industry
So
level
that
best?
is the way it should be, because I mean it depends. Now, for example, Treasury bill yields, right?
Okay.
Treasury bill auctions are every week, right?
Okay.
But there
Correct.
is a secondary market. So, for example, if Treasury bills are issued at 7% at today's auction, okay,
Okay.
tomorrow, because of some reason, Treasury bills could be 8%. The same 7% Treasury bills could be trading at 8. Now,
Okay.
are you going to leave your transfer pricing at 7% because the auction rates are 7%?
Mm-hmm.
You have to change it with the market, because that is the rate today. Today's rate of 8 is the rate that you can go out and borrow and lend at against those treasury bills.
Right. The thing is, like, I'm wondering, like, if they have a different products carries different transfer pricing. There need to be a system to calculate the transfer pricing on daily basis. Manually, you can't do, like, even keying into the system. One just a click of a button that need to be updated. Something like need
Yeah.
to be do. Okay.
But what happens
Right.
is this: like if you look at say transfer pricing for deposits and loans, most
Okay.
of the time in Sri Lanka you only go up to like 1 year active, and then you have the 5 years and whatever.
Correct.
So
Correct.
often it is an Excel sheet with maybe
Yes. Exactly.
15 rows maybe across, and if you have a macro, if you run a sort of a macro on it, you have to daily then key in what that
Mm.
day's rates are based on what is given to you. So, but
Yes.
usually the control functions are able to do that, and the product control functions usually will do that every morning. I don't think it's a long exercise. I think maximum
Okay.
it
Okay.
will take
Yeah.
you
Yeah. Yeah.
15 minutes basically.
Yeah, I'm worrying is like treasury guys might do this daily, but when it comes to like system level, only once in a way it is get updated. That is why I asked that question. Like
So what happens
maybe
in my bank is, I give you an example. What we
okay,
do is the treasury department. It's not the treasurer; it's actually the control functions that does it. So for control purposes,
okay,
they will look at the transfer pricing, and then they say, okay, these are the rates today. They'll key it, and they'll distribute all that to the branches
daily basis.
daily. So the branch
Okay,
guys will have branch guys don't touch the transfer pricing rate. Transfer pricing rates will be set in the system by the control function. Yeah. The
okay,
branch wise will definitely, then they don't see the system rate. They will just quote what the client is on the published deposit rates or lending rates, published rates, right? If
okay.
they want a better rate, then they will
Call.
check in the system, or they will call the treasury and look what is our transfer pricing rate for that.
Okay,
Because they don't
understand.
need to see the transfer pricing unless they are giving an
Correct,
exception, basically.
correct. Yeah. And one question: when it comes to secretary to the ELCO, like who will be the secretary to the ELCO? Is it guy from
Like
the
I said,
treasury
it's
or
usually
the
finance. It's usually finance.
is it okay? That is why you said all minutes and all maintained by him and keep with
That's
him
right. I
thing.
mean, that's my understanding, because what happens is that the three business functions are treasury, consumer, and lending.
Yes.
So they are always going to be the ones who contribute in terms of um, market views, what's happening, all that, right? And then if you have the treasurer setting the minutes,
Yeah.
it is not an independent validation of the minutes. There's nothing that, obviously everybody has to
Yeah. Yeah.
validate afterwards. But ultimately, the finance guys are the ones who manage the financial situation, and they are an independent function. They are a control function, right?
Yes. Yes.
So they set the pack and they look at the minutes, basically.
Okay. And the industry practice is the like global practice is that like normally a finance guy will be function as the secretary to the
Yeah,
ELCO.
that's what we call, I think within finance, there's a separate area called ALCM, Assets and Liability Committee
Okay.
Management. Yeah, so
Okay.
those guys would be the ones looking directly, because even finance has different verticals, right? So this will be
Okay.
one of the
Okay.
verticals that look at that part.
Okay.
Uh, right, very good. So the pool rate. So the pool rate is basically what is the transfer pricing rate? The rate at which Treasury will borrow from the borrowing department and lend to the lending department. To decide on that, the bank will decide on what will be the factors. how many current accounts, how many savings account, time deposits, what those duration of those time deposits are, how much of money is sitting in each of these accounts, etc., etc. Yeah, and basically the tenors on which the liabilities are and tenors on which the assets are. So you take the whole bunch of deposits that you have and which buckets they are in, which time buckets they are in, and where the bank's main risks are in terms of deposits. And then also on the lending side, to look at where the bank's average lending cost is to corporates, and based on that, and what tenors, are we lending long term more, are we lending short term more, etc., etc. So the transfer pricing cost ideally should be the marginal cost. Basically, at what cost, what can the bank get new money to the bank or lend new money to the bank in order to lend. So that's why it has to be validated every day to make sure the marginal cost to the bank is reflected every day. So in other words, you can't be static saying these are the liabilities I've raised at 8%, I've lent them at 10. Okay, that's it. I have to borrow at 10, lend at 10 all the time. No. It is based on where can the next batch of money be borrowed at and where can the next batch of money be lent at. So it's a marginal cost of funds, meaning the next, what can you lend the next dollar at or next rupee at? At what cost of funds can you lend the next rupee at, basically. Stop there. So when you set the pool rate, it should encourage the branch manager to get the money, get deposited at the best possible rate to the bank. And it would help the lending guy to lend money out at the best possible rate to the bank. Yeah. Remember, it doesn't work perfectly like that. Right now, for example, if I were to give you an example, say today interest rates are very low. It's at 7% for deposits. Lending rates are probably still maybe 11%. Yeah. Now, a branch manager sitting somewhere will find it very difficult to raise deposits, even if I say the transfer pricing rate is 7%, and say, no, we are giving you the market rate, 7%, please come and deposit with us. We might still not be able to get deposits. Why is that? Why is that? Even if he's paying the client the interbank rate, he might not be able to get the deposit in. Why is that? Even if the treasury is giving the interbank rate, say this is the market rate, I'm not keeping any margin. You guys quote that, you all quote what you want. He quotes the same rate with no margin, but he still might not be able to get the rate deposit. Why is that?
He might think the rate he might think that rate will go up in near future, like and he will hold in the money until it gets increased.
Very true, but more than that, I think it's also that when interest rates come down like this, almost everybody is paying the same rate. Almost all the banks are paying similar rates, right? So if that bank guy if it's new money, he's already banked me bank Y, and now this bank Z is telling, okay, come with the money I'm giving you interbank. This guy might be getting 6.5% at bank Y. He might not want to move his money for 0.5%. Yeah, but when interest rates go up, we'll say interest rates go to 15%, right? And then suddenly this guy says, okay, I can pay you 15% on a deposit. This guy is getting 10% at his bank, right? Will he move his money then?
With higher interest, of course, yes.
Yeah, so he's getting not 0.5% more, he's getting 5% more, right? So it's worthwhile for the depositor to move his money. Then that particular deposit rate of 15% makes sense, and that is where he can win the money. So the success of the branch manager to raise money or the lending officer to lend money is not only depending on the transfer pricing rate, it does have an impact, but it is also whether interest rates are low or when interest rates are high. Based on where the interest rate environment is, it might be easier for them to raise money as well, and depending on the sentiment of the borrowers as well, on lenders as well. So adjusting the pool rate, I won't go into it too much, but basically when liquidity is low, we increase the pool rate so that we can raise more money. So if it's 8% is the pool rate, we raise it up to 10 if we feel that we need more liquidity. We've touched on that last week as well. And when we have excess funds, we reduce the rate to give out those funds. So you have pool rates, you can have pool rates for different tenors. Like I said, you have like I was telling Ruchira, you can have based on the tenor. I mean, this has 1 month, 3 months, 6 months, but we start off at overnight call money rates going up to even 5 years, 5 years monthly interest, 5 years quarterly interest, various things like that. So this is a very simple graph thing, but basically it's more. There are more. It's a bigger ladder basically that you have.
So one particular question, like when it comes to this secretary function to the ELCO, like if there is a guideline available, like FS guideline says like that need to be handled by independent function like finance.
No, nothing like that. Nothing like that. I mean, I think it's by virtue of how the bank works. There is no guideline to say it has to. Like I say, it could be the Treasury doing it in different banks. I don't know, but ideally, it should be the finance section because I think then they have very sort of clarity on each area independently. What they otherwise, and it's only minute taking here, but creating the ALCO pack and putting it all there should be finance because that way they make sure that there is more. They cover all areas equally, basically.
Yeah. Thanks.
So again, if we expect short-term interest rates to be lower in the future, we do a negative gap. What is a negative gap, basically? If you remember from last week. What is a negative gap? If we expect short-term interest rates to be lower in future, so we expect interest rates to come down, what do we do then?
We lend for 1 year, like more. As example, if you take we borrow 6 months. If we borrow 6 months, we'll lend it for 1 year. Then
very good. So exactly. So you create a negative gap because based on the view on interest rates, like we discussed last week, you feel rates are coming down, so you want to make sure that you make you lend as much as possible out, and you borrow as least as possible in at lower interest rate, just enough to cover from a tenor perspective. So there, your transfer pricing rate has to reflect that view. So you increase your short-term pool rate. So basically, you pay a higher rate, or rather, try to get more short-term deposits. Want short-term liabilities more than assets. So you, like Lucia said, you keep 1 year lending and borrow more assets. Encourage deposits in the short term. Discourage borrowers in the short term. So pool rate, market rate. You can have a higher rate than the market rate, but that's up to you. So if you want a positive gap, basically we want to create more assets in the short term than we want liabilities. You then borrow for a longer term, and basically you lend more on the short term because you expect interest rates to go up. Yeah. This is for short term, because you're expecting rates to go up. You're going to be paying more because you want to basically make sure that you lend as much as possible in the short term. so that you can lend at a higher rate for the next set of short term because you expect rates to go up. So if the strategy doesn't work, what happens? Who gets hurt? If you whatever way you manage your interest rate risk, if it doesn't work, what happens? Who gets hurt? Treasury, yes, because ultimately the role of Treasury is to provide this transfer pricing and to manage the funding of the bank. The business lines that are on either side, the borrowing and lending functions, once they have passed the risk on to Treasury, they don't have any market risk on them. They have credit risk, they have operational risk, they have all those other risks, but they don't have market risk. Market risk sits with the Treasury function. Understood?
Yes, sir.
So basically, direct tools. So if, like I said, if they find that they are either the lending or borrowing rates are not in line with the market or what we are getting from our depositors and from our normal day-to-day clients is not in line, what will we do? We'll go out there and lend and borrow from our in the market itself, in the interbank. So what are the direct tools? We have a corporate deal in there. So in other words, there's a section in Treasury that actually deals with clients. And this section would basically go out and say, talk to clients about doing FX swaps. They talk to clients about doing debentures, derivatives of other sorts, so that they have a direct contact with clients and make sure that we generate the best outcome for the bank from the Treasury. The difference here is that it sits within the Treasury function itself. So for the Treasury as a profit center, there's a cost involved in maintaining all these systems and people. They have to make a profit. Like I said, they have a target, and because of that, they have to be a profit center to maintain all these costs that are there. So in other words, what it's trying to say is Treasury plays an important function of managing the cost of the bank, but also generating a profit separately with its own cost in doing that. People cost, system costs, risk management has different requirements. So it has to generate a profit over and above those costs, basically, obviously. Yeah, so what you have to understand is in the past, a treasurer's function was not a profit-making function. It was just a management function and a liquidity function. But later on, when it became clear that there are opportunities where the bank can actually generate market income and P&L from having a treasurer who is market-oriented, then it became a cost profit center and with its own costs involved in that. Basically, then it became what we call a profit center as well. So let's go to the questions. Question number 1. Okay, theoretically, the treasury position in the bank could be an external sector that makes and places funds. The only sector with dealing desks, an internal sector that has no contact with the market, superior to other departments. Which is, you think, the correct answer? Theoretically, yeah? Theoretically.
A.
Any other answers?
C.
C, okay. Anybody else? Oh, what happened here? 1 second, please. Yeah, it should be C because theoretically I said, not actually, theoretically. Yeah. Second one. Sorry, I'll just go back into that. Why theoretically? Because, like I said, if it was merely providing a transfer pricing rate and managing the liquidity of the bank, then it would have been an internal sector. But it is very much market oriented, like I kept saying, making sure that the clients get the bank gets the best outcome for the funds that it gathers, and in terms of how or what cost it gathers it and what cost it lends it at. And then through that process and through the process of liquidity management separately, it also generates income. So that's why it's not. But theoretically, if you look at it simplistically, it should be an area that has no contact with the market in internal sector. Treasury Department's position in the bank hierarchy is above the corporate, consumer, and financial control, below the other departments, part of the other, equal to the other departments.
See, part of the other departments.
Anybody else?
Equal to the other departments?
Yeah.
Okay. Anybody
Equal
else?
to
Equal. Okay. Equal. That's correct. Because if you remember the organization chart, you had the CEO, you had the corporate banking head, you had the consumer banking head, you had the treasurer, and you had the financial control. There are other areas, but if you take only those four, all of them sit horizontally, basically in the same line of hierarchy. There is no difference, basically. And they are independent of each other for the sake of conflict and for the sake of making sure the bank has independent reporting lines in terms of controls and management, etc. Who set the rate if the corporate manager wants to make a deal to attract a new customer? Who sets the rate if the corporate manager, so this is a lending manager, wants to make a deal to attract a new customer? So he wants to give a rare loan out. Yeah. Who sets the rate to the client? A corporate manager, consumer manager, general manager, treasurer.
Corporate manager.
Okay. Any other answers?
Treasurer.
Okay. Any other answer? Okay. Let's see. Yeah. Remember, corporate manager. That's correct. The reason for that is this is facing the client. He faces the client. So if a company says, I want to borrow, he comes and meets the corporate relationship manager or the corporate, whoever you want to call it, and says, look, I want to borrow, what's your lending rate? That guy will say, okay, this is my lending rate. The lending rate he has decided lending rate based on the transfer pricing rate that has been given by the treasurer and his credit margin. If he wants a better rate because the client is borrowing a substantial amount of money, and he wants to better his rate to the client, yeah, he can do that. But he can go back to the treasurer and says, look, I'm reducing my margin for this guy by 1%. So instead of lending to him at 15%, I'm going to lend to him at 14%. Your transfer pricing rate to me is 13%. Yeah, I'm only making 1% of it on it. Can you please adjust your transfer pricing rate also lower so that I can quote a better rate to this guy and make a little bit more margin on the credit side, because I need to keep minimum 1.5% margin or whatever it is. That conversation he can have with the treasurer. But he is the guy who will face the client ultimately with the rate. Is that clear?
Yes.
Okay. Select the tools the treasury uses to achieve its objectives. Pool rate, ALCO meetings, financial variables. ALCO meetings, financial variables, and direct dealing. Liquidity, direct dealing and financial variables, pool rate, ALCO meetings, and direct dealing. Which one? Tools Treasury uses to achieve its objectives. Objectives of liquidity management and profitability. Yeah, remember that. What are the tools? We learned there are two main tools, indirect tools and direct tools. So within that, which ones are these? Any guesses?
D.
D. Okay. Anybody else? D. We have D. Okay. It's correct. So the direct trade will be the basically the ALCO meetings and the pool rates will be the indirect methods where they use the transfer pricing where they use transfer pricing pool and the ALCO meetings to discuss and decide where the transfer pricing rate is and where the bank should be borrowing and lending at. And direct dealing will be where it goes out in the market and does interbank transactions basically to optimize the returns to the bank. What is the objective of the pool rate? Dictate rates, pool funds, borrow and lend funds, influence rate setting. What is the objective? What is the objective of the pool? Dictate rates. Okay. Anybody else? Why is there a pool rate? Okay, we'll go with that. See, it's not to dictate rates because what happens with the transfer pricing rate, remember, is the Treasury will influence through its indirect methods on what rate the bank should borrow money at and lend money at by keeping the transfer pricing rate at a certain level. In the process of doing that, Treasury also makes money, but it also wants to influence the rate at which the banks can borrow and lend at, taking into account all those factors. The risk is with the Treasury ultimately, but it will influence the rate setting. It won't directly set the rates, but it will influence the rate setting. Is that clear? Okay, the pool rate should be set at the bank's quoted rate at the bank and the rate available in the market to guarantee a profit to compete with other sectors. The pool rate should be set at the bank's quoted rate at the rate available in the market to guarantee a profit to compete with other sectors. So when you say quoted rate, we are referring to the rate at which the bank borrows and lends with the client. But these are the rates the clients see. Okay. So what rate should the pool rate, the transfer pricing rate, be set at? Ideally. There are other small factors, but ideally, what should be the main gauge of the market of the pool rate? I told you it has to be set daily, right? So when you set it daily, what are you looking at?
Answer is A, like bank's quoted rate.
Okay, any other answers?
Or the B, at the available rate in the market. Like.
So you got to pick one, Ruchira, A or B?
B.
B, okay. Anybody else? Okay, let's see. Correct. Because remember, irrespective of where you borrowed yesterday or day before or last month or last week, the pool rate has to reflect the market rate, because that is where you can raise funds at today or lend money at today. The transfer pricing rate will tell you, if for example, you took 3 months ago in Sri Lanka, interest rates were, no, 6 months ago in Sri Lanka, interest rates were about 2% more than they are now. If you are still setting rates at 2% more, you will have a flood of deposits coming into the bank, and you will not be able to lend that money at those rates. So the transfer pool rate has to reflect the changes in the market every day, and thereby the branches and the lending officers will change their rates. It's up to them what kind of margin they want to keep on their client. That's their business call. But the Treasury will have to move in line with the market. Pool rate will have to move in line with the market. Of course, manage to where the bank wants to borrow or lend more, but align the market. Is that clear?
Yeah.
Okay. The Treasury passes funds along at the prevailing rate to cover the opportunity costs, maintain fair relations with other sectors, set rates for other sectors, increase the amount of prevailing funds. The Treasury passes funds along at the prevailing rate to what? Why would the treasurer use the prevailing rates to lend money at?
Cover the opportunity cost.
Okay. A. Anybody else?
Answer A.
Set rate for the sectors. What else? Okay, let's see. Cover the opportunity cost. Because what happens is the treasurer will always look at the next best alternative in terms of lending money or borrowing money for that matter. So it will cover the opportunity cost. So like I mentioned about the treasury bills and the lending to a corporate. If there is a same rate given for the same class, same type of, same tenor of lending, same volume, but the treasury bill rate has a higher risk profile, treasury say, look, that's a better opportunity cost for us. We are losing opportunity cost if we lend to the corporate. We need to put the money into treasury bills. But it also has to look at the relationship with the client, all the other things as well. So that is where the consumer banking head will say no, or the corporate banking will say no, this is a long-term client of ours, we need to support him, blah, 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 blah. That will go on, that discussion will go on. But at the end of the day, that opportunity cost and how the money is passed on is a discussion that the treasury will have with the ALCO basically. Transfer pool rate has to be marginal, which means it must be profitable, updated daily to market condition, average, same as the original cost of funds. Which one is it? The transfer pool rate has to be marginal, which means it must be profitable, updated daily to market condition, averaged the same as the original cost of funds. Which is it?
B.
B, okay. Anybody else?
Profitable?
Profitable, okay. Anybody else? Okay, let's see. Updated it. So what it means is when you say marginal, you're looking at the next best rate that you can borrow and lend at. So in other words, yes, it could be profitable, but if you have borrowed portfolio that is losing money, that also has to be reflected in the rate that you take it in the market today. But it doesn't mean that you continue to do that. You could then be today lending at a higher rate or borrowing at a lower rate, depending on where the rates are. So the marginal cost has to be taken in as to see, okay, now what is my cost of borrowing the next rupee at? What is my marginal cost to borrow the next rupee at? The only way you can determine that is to go out and see where the market rates and the market conditions are. Once you know that, you know whether your marginal cost is going to be 1% more or 1% less or whatever it is. You don't know. That will depend on where the market rates are and where your portfolio is at that time. To manage the gapping, the treasurer sets the same rate for 1 month, 3 months, and 3 months, pools the rates for all tenors, sets a different pool rate for different tenors, sets the rates for all tenors at the day's prevailing spot rate. How does the treasurer manage the gapping? Negative, positive gapping. How will he use the pool rate for that in order to gap? Set the pool rate for 1 month and 3 months, pool the rates for all tenors, sets a different pool rate for different tenors, sets the rates for all tenors at the day's prevailing spot rate. Which one do you think?
C.
Sorry?
C, sir.
C. Okay. Other anybody else?
D.
B or D? Okay, let's see. Yes, that's right. Sets the pool rate at different rates. Like we discussed, depending on gapping, whether he wants to borrow more short-term funds, whether he wants to lend more money in the shorter term, based on positive gapping, negative gapping, he will use the pool rate to do that. So if his view is interest rates are going down and he wants to raise more money, he will first lend more money. He will make sure the lending rate for long term is good to whoever he's lending at. And then he will want to borrow more money on the shorter term, because he feels next time he goes to borrow money, lends will be lower, he'll make money on that. Yeah. So because of that, he will use the pool rate to do that. Different rates for different pool rates to do that. The treasurer wants liabilities and doesn't want assets in the 1 month tenor. What should you do? Treasurer wants liabilities and doesn't want assets in the 1 month tenor. So he wants to borrow money, he doesn't want to lend money in the 1 month tenor. What should they do? The treasurer says, I want to borrow more 1 month deposits. I don't want to lend anymore. So what will he do to the pool rate? Set the 1 month pool rate above the market rate, set the 1 month pool rate below the market rate, set the 1 month pool rate at the current market spot rate, ask the consumer manager to raise more funds.
Set the 1 month pool rate above the market rate.
Okay, that's it. Correct, because he wants to borrow more, right? So, but remember, like I said, that's only one aspect of it. The client has to be happy to bring the money here. His cost of disruption from his existing bank, which is somewhere else, should be taken into account. But yes, one factor is the rate, and the transfer pricing rate is there. It can have an impact on it. It is necessary to have dealers in the treasury to do what? Deal with other departments of the bank, deal with the market to balance the needs of all departments, service the bank's smaller customers, make a profit for the bank. Sorry?
Answer D.
D, okay. Any dealers in this group? Anybody from front office in this in the group? Okay. Okay, you said D, right? Okay. I think I would slightly disagree with this answer. I think it's a combination of all these questions. The answer, if it was me. So I don't think you should necessarily go with this current answer, because I think D is correct. The purpose is also to make profit for the bank. If you look at B, that is also correct, because ultimately you have to balance the needs of the departments. And basically, it's a combination for me of B and D, because ultimately, being a profit center, you also do by dealing with the balancing the needs of the other departments, you also have to generate a profit. So the answer would be B and D altogether, in my view. By dealing directly with customers, Treasury has become more important than the other departments of the bank. A department specialized in customer relations, a department that is internal to the bank, a department that makes profits. Which one is it? Any guesses? Feeds in a little bit from the question number 11 that I just did. Treasury has become what? What were we saying all this? Is it Treasury a profit center or cost center?
Profit center.
Yeah, so by dealing directly with customers, when you deal directly with customers, what are you after?
Profit.
Profit, exactly.
Or,
That's why I said the previous question 11, the dealers, there is a profit orientation as well, not only dealing with other departments. Yeah, that's it. Any questions of what we've done? Okay, so what we're going to do is this. We're going to take maybe a 10-minute, 15-minute break. Now it's 10:15. We're back at 10:30. My objective is to try and finish the section on Treasury organization and structure, which shouldn't take long, and then touch a little bit on control of dealing, which is limits, basically, a Treasury function. So we have altogether about 2 hours to do that. I think we should be able to manage it, but if we are not, then we will have to take a decision on how we do that subsequently. All right, okay, so now what we're going to do is, it's not a very complex area. We're going to look at the structure of the organization and Treasury, where Treasury sits in it. We've already touched on it. We said that Treasury sits equal to all the other departments. It doesn't report to corporate banking. It doesn't report to consumer banking or to finance. It's an independent function of business within the organization structure. Okay, so now what we're going to do is, we've already gone through where the Treasury sits within the organization. We're going to go into what the different functions within the Treasury are. So anywhere in the world, Treasury has three main broad areas: global markets, Treasury, whatever you want to call it; front office, which is the function that basically deals directly with the market; the middle office, and the back office. So we'll go into that detail now. So like I said, from an organization perspective, you have the board of directors, then you have the audit committees, and you have the other various committees that basically the directors have independent sort of sight of. You have the CEO, and then you have the Treasury, consumer head, all these guys sitting there basically. So if you look at it, taking all the, looking at this slide, it looks a bit crowded. But what it says here is this: what the functions of Treasury are, and where what it does in the modern world that we are in. So if you look at, say, one of these, say, risk management in foreign exchange. The guy who's lending will lend money in foreign currency and local currency. How to manage that foreign currency risk, the interest rate risk, liquidity risk, etc., sits with the treasurer, who in turn will have to report to the CEO, and of course make sure that for ALCO perspective, he has all the risk matrices figured out for that, right? Same way for, if you look at the branches, purchase of foreign exchange in the branches, the foreign exchange risk, Treasury has to manage that, report to the CEO, etc. Deposits, same, on the rate side. Investments, the bank has investments that it makes. How does the investment risk get managed? Treasurer has to worry about that. So in essence, all of these equate to one type of risk, basically market risk. Foreign exchange risk related to the market, interest rate risk related to the market, equity risk related to what the market risk might be. So the treasurer has to look at, there are other risks as well, but the main risk the treasurer is looking at is in relation to market risk and liquidity risks. How does market risks basically impact the bank with all these different activities the bank does basically. So basically, in a normal dealing room, as they call it, we have a trading function and we have what we call investment and funding function, basically balance sheet function, and we have also a corporate sales function, which is not mentioned here. So the trading and sales function will look at interest rates in the market, foreign exchange rates in the market, and see whether they can have an opportunity to generate an income for the bank. So for example, if they feel that the exchange rate is going up and they have excess dollars in their hands, can they monetize that by holding on to those dollars? And in the exchange rate goes up, they make a profit. Same way in terms of arbitrage opportunities. Can they borrow in the interbank market and invest that funds invested funds more actively in the market outside? Is there activity like that? The investment and funding part is the part that sits with ALCO. This part will basically look at the funding opportunities of the bank and look at what we said, the opportunity cost for the bank of deploying money cheaply or deploying money more on attractive investments and borrowing money more cheaply. Is that possibility there? It sits within Treasury. It sits within Treasury and global markets. And it's the arm that basically works directly with ALCO. This arm will look at more opportunities to create profit with all the positions created with the whole bank. Yeah. So there is a trading and sales function, and there's an investment and funding. So the trading and sales is part of the global markets bit, and investment and funding sits with the balance sheet and ALCO bit of the Treasury department. These are all within the front office of Treasury. So like I said, Treasury has a front office. So we've discussed the trading and investment and funding. It sits within this front office. Then it has a middle office and a back office. So this is a picture of a dealing room, basically. As you can see, all those screens and everything that happens. For the head of Treasury, he has various desks, and this can change from bank to bank, from how big the country is, how big the organization is, all that. So there's a money market desk that deals in money market products, fixed income desk which deals in government securities, corporate desk, a foreign exchange desk deals with dealing with clients and trading in foreign exchange. A commodity desk, if you have commodities like gold and other precious metals that you're dealing with, that. ALM desk is the balance sheet desk, basically, that deals in assets and basically works with ALCO on how to best fund their requirements. And a derivative desk, basically, depending on the complexity of the market, that looks at using derivative products to generate income for the bank and provide clients with risk management solutions. Usually, this derivative desk will sit within the corporate sales side of the treasurer's purview. Any questions up to now? Okay. So, like I said, keep saying more. No, it's a profit center. It's staffed by dealers, traders. Basically, that's just a name that has come over the years. Assumes market risk meeting present profit targets for all treasury lines and manages all market risk arising from the bank transfer. Like I said, The main thing that Treasury looks at to manage the bank's liquidity and manage the bank's risk is the market risk aspect of things. How does the market risk aspect affect liquidity? How can we monetize on market risk and maximize and also save the bank from any possible losses in the future due to market risk factors? So, looking at the Treasury front office, you have the function, foreign exchange dealing, local foreign exchange lending and borrowing. Fairly straightforward. Foreign exchange dealing means that if your client comes and buys dollars from me today, I have to go out and buy those dollars in the market. At the same time, I can generate a profit by how the trading views the rate to be tomorrow. They can decide to sell the dollars today to the client and hold on tomorrow and cover that position tomorrow, expecting the exchange rate to come down. Treasury is the only function in the bank that has a trading mandate. What do I mean by that? Treasury is the only function in the bank that has a trading mandate. What do I mean by that? What I mean is, the only department in the bank that can use its assets and liabilities and actually trade it and has a mandate to trade it is the Treasury Department. So, for example, the guy who does the lending to a corporate will simply lend money to him. He'll make a margin on the lending. That's it. That's his profit on the lending. The branch manager who comes in, borrows money from the depositor, will keep a margin on the deposit. That's the branch profit on the deposit. A person who sells a credit card to a customer will have a credit card interest earned on that, and as well as the fees on the credit card. That's the profit for the consumer banking person. A treasury has a mandate to trade, meaning it can buy something, hold on to it, and sell it on a later date if the price of that thing has gone up or not. Meaning it has limits and controls in place, but it has a mandate given by the organizer. Yes, you can use your assets and liabilities to trade and make money. So that's a trading function of the estate. That's the only function in the bank that has that ability. Yeah. So you have external linkages. You have counterparties, brokers, correspondence banks, payment systems people, information providers, or regulators. So we'll take one by one. People that Treasury deals with outside, counterparties, your clients. It could be interbank clients, you could be talking to interbank, corporate clients, various people. These are the people who you will sell your products to and who will come to you for guidance and risk management solutions. Brokers. Brokers are people who are intermediaries in the market. So in other words, brokers are a channel of sourcing funding, sourcing foreign exchange rates. So they get paid a transaction related brokerage for each transaction they do. And these brokers come from a historic thing where we didn't have electronic platforms and broker those days. So everything goes through voice brokers who will say, okay, they won't give the name of the person who's borrowing or lending, but they say there is 100 million rupees available at this rate. And then you say, if you like the rate, you say, okay, that's mine. Can I deal that counterparty? You'll check the limits for that counterparty. So the brokers are an intermediary in the market. They only get paid a brokerage for their function. Correspondent banks, these are meant for funding purposes. So if you're sending money to New York, you're a local bank, you should have a foreign bank in New York, which is your correspondence bank, where you can remit those funds to. They are more to do with facilitating your international trade. Payment systems, so RTGS and SWIFT and all these payment systems that you use to make the payments through. Information service providers, like I said, people like Reuters and Bloomberg. They provide information, but they also provide, although it's not mentioned here, There are also platforms to deal. So for example, if you look at Bloomberg, you can not only get information on Bloomberg on the Bloomberg terminals, there are also dealing platforms where without going to a broker, you can actually go on that dealing platform and request for rates. And then the bank concerns, okay, fine, done, whatever. So you don't need a broker for that. It's a platform where you can actually transact with. But the thing about brokers is the brokers have many people they can get source information from and then show the best price to their bank. So that there are platforms like that as well. We don't have it in Sri Lanka, where there are many contributors and they form the new brokerage community through an electronic platform. Reuters, Bloomberg both have that, not in Sri Lanka, but it is there. And then, of course, the regulators like central banks that you have to deal with. The internal people that the Treasury would deal with would be the remittances, the branches, the corporate banking guys, the credit card, the middle office, back office, finance, all the people who provide information, who require guidance on rates, who on a day-to-day basis you have to deal with. And information exchange is through transaction deals in Nostra County. So basically, information can be exchanged in various ways. You can day-to-day transactions, your monthly volumes, your Nostra account balances, your pool transfer pool rates that you have, board rate setting for exchange rates, various things like that. So these are all broadly. There are more, I think, but I think you need to just broadly look at what is the main functions, what are the external linkages, internal linkages, information that is generally read from a front office perspective. But it's more broader than this. This is a very, very simple overview of it. Goes on, fixed income securities dealing portfolio. I think it was not mentioned here, but basically for each one. So this is dealing with foreign exchange, but this is in fixed income. But more or less the interactions remain the same. Same thing. I'll just stop here for a second. If you look at liquidity management, including Nostro, this is the balance sheet part of it. They would deal with interbank counterparties and customers. See, for them, the balance sheet side are more internally driven. So they would also look at a very few people, but they would more or less have the same interaction with the same sort of people. Little less on the balance sheet side than you would get for the other desks, because they are dealing mainly with the interbank counterparties and customers. They don't really look at regulators too much and all that. That is done at the other level. Maintaining regular ratios, basically, again, as part of the function, they deal with central bank, finance, cash, clearing, all these areas, basically. So, before I move on to the middle office, any questions about the functions of Treasury? You can go into the details given there, but what you have to understand is the main thing about a Treasury function, it has many areas that it has to deal with, but it's a profit center. So while making the profit, I cannot overemphasize that anymore. It has to be looked at from that perspective. In order to make that P&L and to manage the bank's liquidity, it has to interact with various people and deal with different products. So foreign exchange, interest rates, liquidity management, all that. And for that, it has linkages with different external parties, internal parties, and there are certain information that needs to be provided to each of those for each of those areas within Treasury to function from a front office perspective. Any questions?
No.
So then we go on to the middle office. So what is the role of the middle office? The middle office role is monitoring risk, basically, and controlling that risk. So in other words, Treasury goes on and creates risk. It goes and buys a Treasury bill. It goes and invests in an investment. It goes and boys foreign exchange, right? The middle office will look at the different risks and identify those risks and measure that risk. Say, okay, you can, this is your risk that you have. This is how much of risk you've taken. And every day it will monitor the risk to see whether it's within, your limits. And then basically, if it's not, it tells you, okay, fine. It's a control function, right? You say, look, your risks are out of control. What do we do about it? From the monitoring I've done, I've found that you've breached the limit. What's the reason for that? Yeah. And then he said, till you get your limits under control, you can't do these deals anymore. Yeah. So it's risk identification, monitoring, and control. So it's a risk management center of the Treasury with risk management, control risk assumed by front office. So what is its function? Like we've discussed, identifying, measuring, monitoring, and controlling market risk and credit risk of all transactions entered into trade. So why do I say and credit risk? So we have one risk, which is basically the market risk, which we understand is when the market moves against how the market risk, what limits are in place for that. So if you have bought a treasury bill for 8%, suddenly the rate goes to 20%, you're breaching your limits. That's market risk. But you could also have credit risk there, which is basically credit risk that you know what credit risk is. You lend somebody money, they don't pay it back. So where is the credit risk for a treasury guy? Predominantly market risk, but where is the credit risk for treasury? What is the credit risk a treasury takes on? Do you understand what market risk is, right?
Market risk is where the fluctuation of interest rate and this thing, how will affect your, yeah.
Exactly. So what is credit risk then?
Credit risk in the sense the ability where the counterparty cannot pay it on time, like
That's
basically.
right. So we understand there's credit risk in corporate banking when you lend to your clients, right? What is the credit risk that the treasury guy will take?
Maybe he could, he might enter into a deal with some other guy, and he couldn't get that particular cash or the exchange on.
That's right. So
Accepted.
Exactly right. So if you're dealing with another bank, say you're dealing with say commercial bank is dealing with NDB bank, and then NDB lends money to commercial bank. Yes, there's a market risk that in the lending rates come down, go up, he has lost money, but that's fine. But if a commercial bank refuses to give the money back to NDB, it's a credit risk. So those are all governed by limits. Those limits monitoring from a credit and market risk perspective is done by the middle office. Yeah. So who are the people that the credit department will have linkages externally with? Obviously with their customers, with correspondence bank, information service providers, regulators, payment systems. But I must be honest, there is very little external linkages between the credit teams and customers and interbank account. Most of the time, that happens by the front office of a treasury department. The middle office rarely would speak to customers and interbank. They would, of course, be giving clients what we call mark-to-market valuations and things like that, but they won't have an active discussion with customers unless they need to independently verify something. Internal linkages are different because of the way it's positioned within Treasury. It will have link with the remittances, branches, corporate banking, all these sections here to validate the information it has on its system. So if it finds it has breached a limit, it might go up to the corporate banking guy and say, look, we've lent this much to this client, we are breaching limits. Do you know whether we've got a increase in limits for that particular client? Or and then make sure that there is something that maybe not be documented that is already in place before, or whether it's a false control breach that we've had. Yeah. And then on a daily basis, they will share information in terms of foreign exchange positions, borrowing and lending positions, loss to balances, and the limits itself. And then they will obviously report these where regulatory required. They will do the reporting function to the regulator. Is that clear? Okay, so like I said, market risk. These are the various things. I won't go into detail, but basically what the middle office will look at: duration, convexity, negative VaR, value at risk, in terms of movement in interest rate, how that impacts the curve, and if the curve, based on the convexity of the curve, what the impact on the limits and the limits of the bank is. The controls they have would be, they might limit the maturities of certain investments, duration in the same way. Convexity, how much of a convexity risk that we are happy to tolerate. Net open position, say, okay, we have a net open X amount, can we reduce that net open position? Can we reduce your VaR limits? Can we have smaller stop loss limits, etc.? So like I said, I won't go into detail of this. That's a separate risk discussion in itself. But these are the things that the middle office will look at from a market risk perspective. From a credit risk perspective, we'll look to see whether you breached the outstanding amounts, breached the counterparty's limits. Is there a risk of non-settlement by a counterparty? Has your credit default swap, again, I won't go into detail, but has the limits, the rate of that has it increased? Is the client's credit rating deteriorated? Do we need to worry about the client settling because there's a credit rate deterioration?
One question, like when it comes to credit risk, bank deal with different type of other banks, and you need to have overnight limits, overnight borrowing limits, overnight lending limits, such as. When it comes to setting up those limits, who will be supposed to do that? Either correspondent banking or someone else?
Not correspondent banking, You mean from a correspondent banking or interbank trading point of view?
Yeah, interbank trading point of view, like.
Okay. So corresponding bank had nothing to do with it. So if, for example, commercial bank wants to deal with NDB bank, the treasurer or the trader, FX trader or the money market dealer, whoever it is, will tell the treasurer, I need this much of limits because I have liquidity requirements. I need to borrow money, and commercial bank is the only one who has money in the market right now. So I need to increase my money ability to borrow from commercial. I don't have enough limits to borrow from commercial. Yeah. So the treasurer will then go to the head of risk. Yeah. Head of risk, the CRO, chief risk officer, says, look, we have a $1 million limit for commercial bank. I need to increase it to $3 million or $4 million market risk, right? Credit risk, where we can borrow up to that amount, not market, credit risk. Then the chief risk officer will ask him, okay, is this a temporary limit you want or is it something permanent? So the treasurer will say, no, I think I'll need it for 6 months, maybe for a year, maybe more, I don't know, but we might say depending on it. So then depending on the type of limits being requested, whether it is a large amount or small amount, the risk officer say, okay, fine, I'm happy with it. I understand why you're asking for it. I'm happy to sign on. That's the chief risk officer, right? And then he will instruct the credit risk team within middle office, okay, look, we are going to increase the limits for this bank by this amount. And then the limits get increased, basically.
Okay. Where, like, is it required to have a maximum limit where CRO can take the decision, or else you need to go to the ALCO level for other decisions, like the cascade level need to be there, or what is that?
ALCO won't
Okay.
discuss individual client limits. That's a
Overall.
discussion that will happen between the CRO, the treasurer, and each of these banks will also have what we call a
Okay.
relationship manager, a person who handles the relationship separate outside of treasury. He will sit within the corporate banking and what we call institutional banking space of the bank. Yeah. So they handle banking. So the relationship manager will know the overall relationship with the bank, whether it's correspondence banking, trading, structures, raising funding structures, all these other things that you do with for institution space. And you say, okay, fine, for this institution, I'm comfortable given the overall risk. The relationship manager say, I'm comfortable within the overall risk that this limit is okay for this guy. And the CRO has to be comfortable from a risk perspective that we are not overextending ourselves to this client. And then the decision is taken from there. The documenting of it happens at the client level, where for this client at this time, based on this assessment, this is the limit now, whether it's temporary or permanent. It doesn't go to ALCO.
Limits need to be reviewed annually basis. Is there a best
correct.
practice like that?
That's right, definitely. It's annual basis or from a trigger event. So trigger event could be this, for example, what I just mentioned. It could be some other credit down rate of the client, credit upgrade of the client. All those are trigger events. But if not annually, yes.
Then responsibility of setting limits for each and every bank is rested with the chief risk officer, is it?
Not really. The responsibility is with the relationship manager for that bank, right? In conjunction with the requirements of the departments that deal with that bank.
Okay.
So, for example, Treasury could have a requirements, correspondent banks could have a requirement. There could be various linkages within the bank. So that guy will look at all that, and then he'll recommend we keep the same limits or we need to increase limits or not. And the risk officer is independent. He will evaluate the request independently.
After
to see whether that fits with the bank's requirements as well, our risk appetite as well.
Yeah, thanks.
Good. And then we have the back office. So back office is more to do with operations. They would make payments, they would verify payments and verify authorization for payments. So they are more to do with when a transaction is processed, they will make sure that that transaction is processed correctly. There's an independent verification of the transaction and there's independent authorization of the transaction. Just like I said, payment processing teams, operations staff prepares and processes payments for all transactions which have been entered into by front office and is scrutinized by the middle office. Assumes operational risk. So in other words, transaction confirmation generation, following up that those transactions get settled, making sure that clients' deals are independently confirmed over a phone once what we call affirmation, once the dealer has done a deal. All that happens from the back office. They are more operational and then they assume operational risk. Operational risk is an error due to operations. So for example, you send out a confirmation to the wrong client. That's an operational risk, a reputational risk also. Or when you are processing a transaction, instead of processing it for $1 million, you process it for $100 million. Now the dealer has done the deal correctly, everything is fine, but the guy who's doing the payment presses the wrong button and puts an extra zero. It becomes operational risk basically. So we just jump into the transaction flow here. If you look at it, you're a counterparty, you're a client of the bank, basically, and you basically take a deal with the you make a deal with the dealer here. Yeah, you could either do it directly with the dealer or you can come through a broker. That's up to how the market functions and what the best way of doing it. Or like I said, you could do it through a dealing platform. So you have different ways of dealing directly with the treasury here. You can come directly, come through a broker, you can come through a platform. Yeah. And then once the deal is done, the counterparty will then basically send a confirmation to the bank saying, okay, I've done this deal with you. Sometimes the confirmation comes on the electronic platform, sometimes it comes directly. Yeah. Then what will happen is the settlements team, which is in the back office, would check the trade details against the confirmation. They check the value date and whatever other things, and then they will process the transaction, right? Yeah, and then basically once the trade is in the books, depending on how the systems work, it'll update it for the P&L impact of the transaction, the profit made on it, impact on liquidity, etc. gets processed. Usually what happens is when the counterparty deals with the guy over here or through here, these two, and the dealer puts the deal into the system, automatically the systems get updated and the whole process takes place very fast. The only thing that needs to worry that the settlement guys have to be careful is the dealer could be dealing for the same day value, could be dealing for spot date, could be dealing for forward dates. So the settlement guys have to make sure the settlement goes through at the correct time in the correct way. But the updating for the finance and P&L purposes usually happens at the time the deal is booked at the same point itself. Is that clear? Okay. Yeah, so this is just about reporting. Basically, all foreign exchange transactions, and this depends from country to country based on the regulations. Now, here in Sri Lanka, if you have foreign exchange transactions, this has to be reported to us this is basically reporting internally, sorry. Because central bank then also requires us to report it to them as well. But for this purpose, it's about the bank itself. So all foreign exchange transactions have to be reported to the front office by the branches, so that the branches can actually manage the risk by the treasury, so the treasury can manage the risk. Yeah, and there are deadlines and cutoff times put there so that the risk can be managed in a timely manner. If not, if markets close, you can't do that. So there are different cutoff times for different currencies and different cutoff times for different lending and borrowing requirements. Sri Lanka, we use the RTGS system for payments. This is managed. Treasury has basically, how can I say this? The systems get updated, and then at a certain time, the Treasury knows how much of money it has in their central bank accounts and knows whether they are borrowed or overlent. And then based on that, they have to manage their funding requirements for the day. For that, you have clearing, you have slips, all that goes into that, and the back office has to make sure that they update all that and keep the treasury guys informed that what the eventual position looks like for them to manage the liquidity of the bank, funding of the bank. That's it for this one. Let's go into the questions you can ask. Okay, that's about it. Any questions on this one? Sure, I don't have questions for this. So the main things you have to understand here is Treasury has 3 areas: front office, back office, and middle office. And within the front office, there are various functions the Treasurer takes, and the back office, middle office function is to manage the risk, monitor the risk, and control the risk, and inform the risk. And the back office function is made to manage the operational risk and basically settle those transactions and go through the operational side of settling those transactions. Any questions?
When it comes to deal enter into the system, say like
Yeah,
you might have like treasury bill transactions. What will be the ideal process? The first time who need to key in the dealer,
The dealer has to do it. I mean, basically,
Okay.
it's like this, right? The dealer would, how can I put this? As long as the risk price is mentioned and the branch knows where the risk price is, meaning where the interbank rate is at that time, it doesn't matter. It doesn't matter who enters the customer leg of the transaction. So, for example, if somebody walks into the branch and says, "I want to give you $10,000," the branch guy looks at the rate and says the rate is 185. Now, if the guy says, "I want a better rate," branch manager might call the dealer and ask, "Okay, can you get a better rate?" Dealer might say, "Okay, 186. My rate is, I can give you interbank rate is 108, 189. I can give you interbank at 190." So then this guy goes back to the customer and says, "I go to 186." He's giving him a rupee better. Now, customer says, "Okay, fine, no problem. Go ahead with the transaction." Okay. Now, the branch guy is the one who will enter the deal into the system, and he will then put the dealer's rate. He will confirm the rate to the dealer. Now, how he confirms the rate to the dealer, the only thing the dealer is worried about, yeah, is the rate of 190 that he has given the guy so that he can manage his risk. Okay. Now, the question comes as to who enters the deal, right? Depending on the systems you have, you can either the branch guy can enter the deal or the dealer can enter the deal. So most places now, to reduce the lag time, the deal is entered by the branch itself. Yeah. So the branch will enter 186, and they will also enter the new rate that was given to them, which is say 189 or whatever, or that rate is, which pops up on thing and say, "With this rate done," and they will then make sure that they process the rate transaction at those rates. Yeah. Some cases, if the branch calls the department, the treasury guy, if the client calls the treasury guy directly, which can also happen, then he would put the deal into the system with the customer rate and the interbank rate mentioned. Yeah. So it all depends on who interacts with the client and the systems they have. But there is no right or wrong way of doing it as long as the customer rate and the transfer pricing rate are in the system correctly. That's all. So as
Suppose
long as
when
the treasury guys can make sure that they are getting the correct transfer pricing rate and the client rate is also accurate from a P&L perspective, it doesn't matter who puts the deal.
suppose like branch enter into a currency sale or the currency buy,
Yeah.
but treasury guy doesn't know. He enter into the system and buy your sale, but at the end of the day only will when treasury knows this guy
That's
has
right.
done this much, then it's issue. The if
It's the
exchange
issue.
rate.
So that's why there are very clear guidelines as to if you process a transaction without contacting treasury for something that is not within the usual course of business, and if there's a loss associated with that, that loss goes to the branch.
All right.
So that they will make sure that they follow the process.
Okay.
That
That's
way
what
you
I was
control the branch, because then the branch won't do anything like that, because most often systems are different. They will process on one system, only the next day you will figure out whether there has been a loss or not, or whether there has been transaction. So that's where the middle officers and the back officers come in. They monitor these transactions and tell treasury, "Look, this trade has gone in, do you know about it?"
But when it comes to other transaction like forward transaction and all, always that need to be referred to treasury to get a rate. Branches can't do such thing.
True, yes,
If
that's
you
right.
want to
But
forward,
now we have systems for that as well, where the client can actually do the deal directly on a system with because it's the treasury doesn't have to call and give the client a rate. The client can see the rates on the system and pick their rate basically.
Okay, forward trades he can witness by you log into the his.
That's
Okay.
right, and they can book it directly on the platform, the client-facing platform, basically.
Just matter of keying the correct system in correct forward system into
Somebody
the.
has to manage the rates on this side. That's it.
Right.
It's a different channel, that's all.
Okay. And one particular question, like when we do the deals with the dealing platforms, will it directly routed to the our this system, or are we need to key in into this? What is the best way? Like
Good question. I think what happens is you can't have a system that directly routes into the accounts of the customer because of regulatory requirements.
Yes,
And you
that
need to
should,
check underlying transactions and all that. But the client
Yeah.
can go and book his rate like he would book on a voice transaction call and say, look, I want to buy, sell. Same way he can do it on the system. But finally, he needs to send the documents to the bank to settle the transaction, right? So
okay.
that settlement, at the settlement, if you find that even in the voice transaction, same thing happens. If you find that something is not right in this transaction, then you will have to cancel it. And then if there's a loss, the client will have to take the loss. If it's a bank's fault, the bank will have to take the loss, whichever way, right? But either way, then at that, even if it's voice or on a platform, the accounts can get debited only at the point of the client settling and making sure all the documents are there and funds are in the account, basically.
Okay.
Right. Okay. So no more questions. I'm just going on to this one now on treasury management and control of dealing. So control of dealing is basically, we've already touched on a bit of it basically here. It's what the risk middle office looks at, and the treasury looks at also at the point of dealing. What are the limits we have that we have to worry about at the end when we go into transact with the client? So basically, explain the requirements for dealing, identify different types of limits, and understand best practices in dealing. So why do we need limits? What are the limits? What are the counterpart limits? What are the portfolio limits? What is the stop loss limit? What is operational policy? And auditing, basically. Yeah. So control of dealing. So basically, you understand, especially if you looked at the last 3 months and looked at how markets have been behaving, that if proper limits are not in place, even the smallest mistake can lead to substantial losses, because markets are unpredictable and market risk is unpredictable. So you cannot put your finger and say, yes, this is going to happen, or this is not going to happen, or this will happen in this way. It's always going to be a certain element of risk. So within the risk, you also have opportunity. So the secret is to try to make sure that you balance that risk with the opportunity that you can make to generate income through those kinds of opportunities. So you all would have heard about bearings and how one trader who did some unauthorized activities cost the bank and basically brought the bank down because nobody could figure out what his actual positions were and what he was doing. So that's because the control functions were not good enough. Yeah, and it was not a priority of the bank, basically. So like I said, I will just go with my experience. We have 3 lines of defense. We have what we call a first line of defense, second line of defense, and third line of defense. First line of defense is control is the person doing the deal. I am the guy doing the deal. I have to make sure when I do a deal with a client, does he have the credit limits? Does he have the settlement limits? Does he have all these other requirements? Is there any risk that there is financial control risk? All those I have to take into account. Financial crime, FCC. And then I do a deal with the client. Fine. So I've done my part. Second part of it is the second line is the credit risk guys, the middle office guys. They go back and say, okay, this deal has been done. Is anything popping up here that is not right? Has the dealer made a mistake in any way? Do we see something? He's fine. And then the third line of defense is audit. So the audit will come in and say, check everything that the control function has done, check everything that the front office has done. So okay, fine, everything looks okay. And then we have a fourth line where it's a regulatory audit. It's not the bank, but external auditors. So the 3 lines of defense of the bank have to make sure that everything is okay, so that when the external factor regulator comes and checks, there is no concern. So why do you have control of deal? To safeguard the assets of the bank, ensure to adhere to management policies. Yeah, so you need to have controls in other words to make sure that you safeguard the bank, and you safeguard the bank from a reputational risk as well as from a overall risk in terms of profit, impact in terms of P&L, as well as from a reputational risk as well. So that goes down to your credibility and creditworthiness. So for that, you need adequate controls. You need to make sure there are no conflicts. That's what I said, that basically the corporate banking treasurer should not read to the corporate banking head. That could lead to conflicts. The finance guy should not have anything to do with the treasury, and the treasury cannot influence the finance guy. The risk management roles sit within the finance guys. So the middle office and back office actually report to the financial control section, not the treasury section, so that there is no conflict between the treasurer telling the middle office, look, ignore that, that limit will be okay. He can't do that. He has to it has to be a separate independent thing. So there has to be suitably, responsibly the divisions there. And all these limits has to be properly documented and put into the systems so that you know exactly what your limits are. You can't have one limit on one system, another limit on another system, another one on Excel file. It has to be very properly documented on one place, so that when a dealer is doing a deal, he is looking at the right limit. He's not looking at a limit that has suddenly, will change in the next minute. So he has to be confident that the limits that are there are accurate.
One question, when it comes to limits, like those limits need to be reviewed annually or as and when required. Like when it comes to these days, the pandemic situation is there.
No, that's what I mentioned earlier. Annually is the normal situation, but trigger events like this, COVID, if it's even say Easter Sunday bombing, suddenly there are clients who are impacted by it. If a client is going for a big borrowing, if you see that there are certain activities happening with the client, his credit rating has dropped.
Okay.
All those things are trigger events. So there is nothing to say that you have to wait for a year. Sometimes it could be a sectorial limit review. It could be an individual client limit review. It could be a limit review for the whole bank based on event, like what you have mentioned just now. It can be anything. There is no one methodology. And sometimes you have more emphasis on risk management than you have on business growth. So for example, by your normal business is go out there, lend money, borrow money, do your trading, make money for the bank. You could have more emphasis in certain kinds of risk management. We need to manage the risk of the bank more. It's more important than anything else. So then you will do more periodic reviews than normal.
Okay, then dealer limits, when it comes to dealer limits, also need to review likewise. So
yeah, that's the thing. So we are coming to that. When dealers limit, you can't like it says here on slide number 7. You need to set dealing limits based on what the usual course of business for that dealing desk is. Yeah. So for example, if they need $50 million or whatever limit, that $50 million has to be set based on past patterns of trading and what the dealing requirements. So for example, if he says $50 million and for one whole year, he's done only $20 million worth of transactions for a day or whatever it is, right? The question should be asked is, why do you have so much of limits? Why do you need it? You're not doing so much. So if this guy says, no, I don't, but there could be days that I have these big ticket transactions for which I need that big limit. Yeah. Then you say, okay, why not for that particular day? Why don't you just get one-off approval to do that transaction? Why do you have to have a limit throughout the period for that amount? Yeah. So that is very much a function of what the volume of transactions and the amount of risk the bank is taking or the desk is taking for that particular asset, foreign exchange, interest rates, whatever it must be. And it depends on things. So now central bank also has a requirement locally for, depending on the seniority of the dealer, there are individual limits set. That again becomes a function of the management of the bank and how much they want to give each dealer, for example, to deal with.
Yes.
But it's those are all within the scope of the volume of business and the risk we are willing to take. The limits are governed by that, and it can change.
Normally, who set the limit? Market risk is the one who set the limit. Or
Same way. What happens is the dealer will ask the treasurer. Treasurer will then put a limit request to the CRO, and the CRO will ask questions and then set the limit based on that.
okay.
See, it says here in the slide in the org chart in slide number 8. See, dealer limits. There are profitability. In other words, if he's losing money, dealers can lose money. Traders can lose money. There is a limit on how much they can lose. It's called a stop loss limit. And they can basically say, okay, this is my maximum stop loss for a transaction, for a day, for a month, whatever. And that again, the treasurer has to have a conversation with the traders and then recommend a limit that he can propose to the CRO. And then based on that, the limit is set. And so your stop loss limit for a day is $10,000. You can't reach that. Yeah. And then you have a stop profit deal. So basically, if you are making profit, sometimes it's not called a stop profit, it's actually a take profit deal, where you're making, say, $50,000 on a transaction. Maybe you can go up to that and cut your limits. But that usually is no limit there. It's up to the trader to decide how much he wants to run. But there is definitely a list for losses, a limit for losses.
That means at the end of the each day, someone at market risk need to be prepare the PNL of the particular dealer and check against the limit. Like you
That's
need
right.
to.
No.
Okay.
What happens? The dealer will do it on day one,
Okay.
right?
Okay.
He will check make sure that he's within his stop loss limits and all
That's
that.
fine.
Yeah. The next day, the market risk guy will say whether there has been a breach or not.
Okay. Oh, that means he need to monitor that. Yes, correct.
Yeah, sometimes it could happen on the same day, but often it's because the reports are generated overnight and then he can take it. So, okay, you have breached the limit yesterday. Do you know about it? That's why it's the responsibility of the dealer to make sure he stays within his limits.
Okay. If particular dealer supposed to take losses continuous basis, CRO can interfere and tell, look here, you have lot of losses. We need to reduce your limit. Something like happened in the practice. So no, like.
No, what happens is there are daily stop loss limits. There are weekly,
Correct.
monthly, various,
monthly,
and for different asset classes, everything. Now the treasurer is the one responsible for the P&L. So if you are making losses continuously, he will have to account to the CEO as to why this is. But if he is confident it is because of a market movement, whatever, the CRO can't interfere there as long as it's within his limits. Yeah?
Okay.
Yes,
correct.
As long as it's within his limits, there's nothing that's fine. That's why those limits are given, right? If it's breaching the limits continues, obviously, yes, definitely. But if it's not breaching it, it's just a mere fact of him losing money. That's a business call.
Correct.
Then the treasurer is accountable to the CEO. Say, look, why are you making losses all the time? You know?
True, very true.
And the dealer limits are then okay. So that's profitability and then risk control. So basically, asset limit on top of transaction size, turnover, bar limit, all those limits to just show you what kind of volume of transaction. This is nothing to do with P&L, but what kind of turnover, what kind of volume you can actually do with the risk limits you have. So you can't do $100 million worth of transactions. You can do only $10 million worth of transactions, right, for example. So there are different types of, like within the limit structure also, what we call dealer limit, which we have just discussed. There are intraday limits. Intraday limits is limits that you have during the day. Overnight is what you can carry overnight. So which one do you think is more, intraday or overnight? Say, for example, a limit is, say, I can carry $10 million against rupees overnight. But intraday, how much of limits could I have? Where I can be plus dollars against rupees. Intraday is during the course of the day. Do you think it'll be higher or lower than my overnight limit? If the bank tells you, you as a dealer, if you have a view on dollar rupee, that the exchange rate movement, I can let you buy dollars against rupees and hold on to up to $10 million overnight to monetize your view. You have stop loss limits, all that, but overnight I'll let you hold on to it, $10 million. Okay. Intraday also I'll give you a limit. How much do you think that intraday limit will be as opposed to your overnight limit? More or less?
Less.
It will be more. The reason I say that is you're there during the day. So you can manage.
Okay. You can do, and yes, correct.
Yeah, because the market is open, you're there.
Yeah,
you can go up to say by $15 million intraday. Fine. You have a client position that you need to manage, whatever. But overnight, I am only comfortable in giving you $10 million. I can't do more than that. So the intraday limits can be more than the owner. Not all the time, but it can be more. Overnight limits in Sri Lanka, we have dollar rupee limits for central bank has governed, regulatory given. Sometimes the banks can have up to the maximum of the central bank limits or less than that, depending the bank's own internal appetite. But we are always going to be capped by central bank's limits for dollar rupee, especially. Effect foreign exchange. Okay, that's position limits, and then loss limits are what we discussed. Again, they can have intraday higher loss limits than it would be for monthly limits. So for example, monthly limits will be more because it's accumulated sets of limits, but intraday limits will tell you, okay, there is a dealing room limit for losses of X amount. At a dealer level, you have a limit of this amount. The dealing for that particular asset class, you can go within the course of the day, you can go out a limit of this amount, and for the whole month, you can go up to a loss of this amount. Why is there what you call a loss limit here? Why is there a loss limit? What is the reason for that? Remember what I told you earlier? What is the only function of the bank that has a trading mandate, license to trade? Which is the only function of the bank that is allowed to trade? What have you been learning all this time? Which function? Which area? Which area of the bank is allowed to trade? The dealing room. The trading function of the treasury, basically. So if the treasury, but the bank is not going to just allow somebody to trade with, assets and liabilities of the bank without controls. And if bank understands that, yes, while you are going to trade, you're going to make money sometimes, you're going to lose money sometimes. So they will put a cap on how much you can lose. So this is the maximum amount on a day you can lose, on a month you can lose, on an intraday you can lose, all that. So that it's controlled dealing. It's not just trading the way you want to, you know. Like Ruchira asked at the time also, if somebody is continuously losing money, then the treasurer has to go up and think, okay, no, I'm going to cut his stop loss limits and not allow him to trade for a while. Maybe there's something wrong. It could be the case. But it's all very much a decision that needs to be made. So portfolio limits refer to limits by the portfolio that you run. For example, if it's a fixed income asset group, how much can you hold on in terms of volume? How much of tenor can you hold on to of that? What's the asset class? So it all depends on the type of portfolio you have. So you can have a higher portfolio limit for treasury bills and bonds, a lower portfolio limit for other, corporate debt instrument, depending on your risk appetite. So we have something on duration, convexity, exposure, and VaR. Let's see. So portfolio limits will be based on these aspects, what the duration is, what the convexity, basically meaning what a movement in the curve, how it has an impact on the rates, then value at risk at point in time at a certain confidence level, what the risk to the bank is, and what the overall exposure to the bank is. So the limit setup is based on factors such as this. And then the bank is, okay, this is the amount of volume of certain asset you can buy. And this is the type of asset you can buy. And within that asset, these are the tenors and the type of asset class you can buy. AAA rated, BBB rated, CCC rated, whatever. All that comes down to looking at these things, looking at the overall risk, and then say, okay, fine, this is what we can tell you, you can buy on a day. So counterparty risk, there are three areas of counterparty risk. One is basically the settlement risk, basically that the counterparty will not settle you. This is from, again, we're talking from more from a market risk perspective, adding on to credit risk, that he'll settle you, not settle you at all, or he will settle you early. If you settle you early, you have to then go out in the market and unbind the contract, which can have market risk then. And then issuer limits, basically meaning that for that particular investment with a counterparty, is there a risk in the type of issue that he has floated, basically. So this is coming back to the question that Ruchira asked, trading limits. Senior management approved limits by type, period, currency, maximum aggregate limit for each deal by virtue of how the person has been dealing and what kind of volume that the transactions the bank does. Authority is vested with the treasury manager, chief dealer. So basically, the treasurer is responsible and the chief dealer, who is basically the guy who deals predominantly, to ensure compliance and within limits. So if not, he is responsible to figure out why his dealer has not kept to those limits on trading limits or whatever it is. And then he has to then speak with the CRO and the CEO based on that. So trading policy. So it will tell you on what basis a dealer will deal. Outright open positions for daytime trading, all time must contain within the limits. So intraday it has to be within limits. Any mismatches in deposit loan or the trading limits must be contained within the specific authority and delegated in writing. Likely excesses and overtrading limits must be reported promptly and approved in advance. In other words, what we've just saying in all this is, look, when you're trading, you have a policy, you have limits, you have to make sure you maintain those limits while trading. So that's what I meant. You are what we call the first line of defense, meaning as much as you're dealing to make profit, it is your responsibility as the trader or dealer or whatever you want to call it, to make sure that you maintain the limits that the bank has set throughout the time of dealing. If not, that will get caught the next day. But it is your responsibility at day one to ensure those limits are in place while you're doing your profit-making activities. So all this says the same thing. you undertake counterparties with only with risk there. So how do you figure that out? You have to go into your systems, check whether the counterparty you're going to do has approved limits. Each dealer must ensure profitable use covering of surplus deficit overnight as projected. So the traders must ensure that at the end of the day, they are within their net open positions, they are within all their limits, the cash balances are not in deficit, everything is okay before they close up for the day. This should not enter into deals where the agreed rates substantially differ from market for specific approvals. In other words, nowadays dealers have specific rates they can quote to their clients. If they exceed those rates, next day it will come out in what we call an off-market rate check. So they have to make sure that the rates are within the market rates. If it is not within the market rates, they have to document the fact that why it isn't in the market rate, get approval for it. Demonstrate that there has been a reason that we have to quote a rate that is different from the market rate because of various things. That can happen, but it has to be documented. Act prudently, and anything that goes beyond the policy must be documented very carefully and get approval separately. Yeah. So again, operational policy, same with the back office and functions. Everything has to be recorded, processed, monitoring of trade must be clearly defined and well understood by the parties. And like Ruchira was asking, it has to be well documented in your process manuals or in any of those other documents that you have that tells you how to deal operationally. Again, each dealer is solely responsible to account for the positions maintained. They have to record their own blotters to make sure their blotters are up to date. They have to then make sure that at the end of the day, all the transactions they have gone through have been properly put through to the settlement departments. And basically, end of the day, make sure that they are within their limits when they close up for the day. Yeah, so it's just talking about the operational side of things. So it's not very difficult to understand. So what happens in a dealing room, like I said, is when a client calls you, you take the phone, you talk to the client, you do the transaction, and then you enter the deal on the system, right? When you talk to the client on the phone, you are recording a transaction immediately, and it's in the surveillance system. Yeah. So if there's a discrepancy later on, the compliance department can look at that surveillance and see whether what the client is saying is right or what you're saying is right. That's one aspect. If not, the client will walk into the branch, give written instructions to the branch, and then process the transaction. So the written instructions form the validation that this is what the client said to do. And the rate, everything agreed is there. So then the branch guy will just use the rate put by Treasury on a system and process the transaction. If not, the client will come on a dealing system like Reuters or Bloomberg or whatever, and then that is the record. That is the basic record of the conversation you've had with the client and the deal that you've done. Yeah. So the traditional way of doing it is on a voice transaction, which is slowly now going away and being substituted by electronic platforms, where the client itself is generating the deal either by agreeing on a deal that is already on the system and then sending the instructions to the bank separately, or by negotiating through like a messaging system with the bank on an electronic platform. So the discrepancies, the discussion, the conflict that can happen on a voice conversation is not there now because it's all written down electronic. More and more, that is what is happening now.
One question, sir. Now, when it comes to call recordings, does market risk need to monitor whether if the dealers enters all transaction according to the call, like that sort of a control need to be there?
No. What happens is if there is a conflict, because what happens, I said, once the deal is done, the client will send instructions, either written form or electronic form.
Electronic form, yeah.
So the deal that the dealer will done will be independently validated by back office against those instructions the client says.
Correct.
If there is a discrepancy, then, and if the dealer insists that he didn't make a mistake, in
Okay.
his transaction, then you go and check the recording.
Fine, but in the sense, as the control perspective,
Hmm.
was it not a requirement that market risk need to check on like sample basis whether the call recordings are properly recorded or not, something like
Yeah,
that?
yeah. That is an audit requirement for the purpose of
Market
making sure the control is in place, right? Not to
whether
validate the conversations.
correct. Only use at the time of a discrepancy only we refer to the but because this latest central bank regulation is also there, they need to make sure up to 6 years you need to have that
Yeah,
call
yeah.
recordings.
That's correct. That's you need you to validate that separately to see whether your recording system is working. And in our case, if you
Yeah.
are pulling out a conversation of a client with the
Okay.
dealer, it has to get
Okay.
approval from compliance
Ah, is that so? Right.
because those confidential conversations are confidential.
Correct. Yes.
So even back office or middle office can't touch those.
Okay. Then who
Compliance team,
ensure?
compliance
Okay.
team independently do it.
Okay, and then that is responsibility of compliance to ensure that all records prior to 6 years are available.
No, not yeah. From a
Yeah,
central bank perspective, yes, that's right.
correct. Yeah. That's right. Okay. In our case, market risk does this. That's right.
Yeah, but we have a separate compliance function who basically works with for central banks. So they have to, no, what they will do is, let me put it this
Okay.
way, they will tell
Okay.
the operations guy, you have to make it, you have to keep this available for 6 or 7 years, right? But
But how dealer ensure dealer also can't hear his recording.
no, dealer has nothing to
How
do with
can he
it. That is
ensure?
up to the control functions.
Okay.
That is
Okay.
why that is nothing to do with the dealer. Dealer does the deal. It's up to the
Yeah.
control functions to make sure the recordings are kept for the 7 years. Compliance
7
will
or 6
lay
years.
down the guidelines as to what the requirement is. If the control function says, look, we can't keep for 7 years because we don't have the technology, then
Yeah.
compliance has to raise that to central bank and say, look, we can't keep it for 7 years because of these, and then there's a different discussion that will happen. But the
Oh.
control function is responsible for maintaining the records. Compliance is there to monitor the work of the whether that is happening or not or whatever. But they lay down the guidelines as required. But they don't have,
Okay.
and they are the ones who have to approve anybody accessing those conversations.
Okay. Thanks.
So we go into a section called moral and ethical policy. Basically, each dealer, because of the way we trade, way we deal, there's an ethical code that we call. So we have the ACI model code, we have the global code for foreign exchange dealing. Basically, that is there. Basically, all of this will tell you what kind of dealing practices you should have, how you should uh, sort of resolve disputes, and basically make sure that you adhere to a high level of ethical behavior. Because remember, when you're dealing with people, like we said earlier, when you do a deal on the phone and the deal is done, or a platform, the deal is done. The instructions come only later on. So if there is a dispute because you've got the value date wrong, the rate wrong, the amount wrong, or something like that, right? At the time of deal, I'm not talking about limits here. I'm not talking about keeping limits that you anyway need to make sure. I'm just talking you said buy when somebody else said sell. Simple as something simple like that. Then there's a code of ethics that the dealing community has to follow. And then based on that code of ethics, practice that ethics based on different scenarios. So nowadays, there are the Bank of International Settlements Global has come up with what they call the global code of foreign exchange dealing. The global code tells you in different scenarios, different behaviors that you have to practice. There are 55 principles, if I'm not mistaken, there, that give you a broad guideline as to what your ethical practice should be in different cases, in different scenarios. This has all come about after the global financial crisis, where you found that a lot of behavior was questioned. And then the bank BIS decided that they needed to have a more robust policy, and that's why they came up with that.
You mean Forex Global Code?
That's right, exactly.
And one particular question: will dealers are allowed to do the transaction using his official mobile phone, and how will it get recorded?
Good question, Ruchira. That is like this. The simple answer is no, you can't. The only way you
If it
can
is
do it
official,
is if it's
no.
recorded. And if since mobile phones in Sri Lanka are not recorded, you can't.
Okay. But you can use cloud service or something like that to record it in the cloud and
It,
see. But
it all depends on how comfortable the surveillance, two aspects of it, okay? One is
okay.
how comfortable the surveillance department is, compliance is with the type of recording that you're taking, right? Second is what will hold up in a court of law.
Okay.
The source of information you're getting, the storage you're getting, should be something that will hold in the court of law. So if the cloud is permissible as a source of evidence, then yes, it can be used. If not, no. I don't know the answer to that. I'm just saying,
Yeah. I just yes.
Yeah.
At HSBC, you won't allow to do dealing using a mobile phone.
No, you
That
can't.
is even
Because our
from
mobile phones cannot be recorded. And in Hong Kong, there is, so the people in Hong Kong can deal on the mobile phone because their mobile calls are recorded. But then still they have to be in an environment where they can access rates. So, for example, they can't deal on a mobile phone. In fact, in our dealing rooms, you're not allowed to on the mobile phones.
Okay.
It's not allowed to on. So you can only on it when you go out. And if a client does call you out when you're outside and you need to do a deal, if the phone is recorded in Hong Kong, you can do a transaction, but you have to come back to your main desk and make sure that the deal is processed correctly, right? In Sri Lanka, you're not allowed either way because we can't record the conversation on the phone.
And why does dealers do transactions over the mobile phone?
They don't have to do it, but the thing is accessibility, right? If somebody wants to call you and you're calling the office line and the office line is not being picked or it's busy, customers often might know your number and they might call you on your mobile.
Okay. So
it's not by choice. I think it just happens because of the way things are, right? It's easier to call somebody on a mobile than on a landline. That's a fact, right? Even not only calling, even texting is not allowed. WhatsApp, text, whatever, that is all illegal, basically.
Sometimes brokers used to call as well,
So brokers is like this. Brokers again should call on the landline. But the thing is this, right? You could have a customer who is a friend of yours. He can call you to just have a chat. You can't stop the fellow from calling you and talking to you as long as he's not talking about dealing activities. Yeah. So it all depends on what the conversation is all about, right? Same with brokers.
Correct. Even at HSBC, you also won't allow to take mobile or all the other dealers
No, you can't. Nobody can.
Okay.
In fact, anybody coming in from outside has to turn their mobile phone off when they come into the deal room.
Okay, that is good.
Not only mobile phones, even like personal laptops, iPads, iPhones, this watches, Apple watches, all this not allowed.
Okay. Good, yes. Even central bank guidelines says somewhere around you can't use mobile phone inside the dealing room or something.
You can't. It's because of the recording part of it. You need to be able to record it.
Thank you.
Yeah, so there are other things like it talks about relationship with counterparties, entertainment, which basically into gifts and entertainment, which falls into bribery and corruption. So there are different policies for that. There are gift and entertainment policies. There are anti-corruption policies. There are, now for example, again going back practically, we are not allowed to accept gifts from brokers. We are not allowed to accept gifts from public officials. There are limits that we have when we are giving, say, year-end giveaways and so on to certain people, depending on the type of person they are, whether they're public officials, others. There are limits that you have. If you take a person out for lunch and for dinner, there are limits that you have to maintain. Certain people you are taking out, you have to get pre-approval before you take them out. So there are controls like that to make sure that you are not getting favors in your day-to-day activities because of your relationship with people. all that also falls in the moral and ethical part of it. But one part of it is what you should be doing, and you're doing the right thing. Other part is controls that are there already to make sure that you're doing it.
One particular question. Now, when it comes to dealers does deals, and you might get particular certain more deals with the one particular counterparty.
Yes.
To restrict that, you might have broker concentration, like you might have the up to 30% or something like that. Suppose if dealers does the transaction with that particular counterparty without paying the commission, direct deals, then
brokers, you're talking about brokers, right?
yeah, brokers. That sort of a thing, like how do you think will
brokers have an association in Sri Lanka, and the brokers
Yes.
association has standard tariffs.
Correct.
So whatever you do with the broker, it goes under the standard tariffs. Yeah.
What I'm meaning is, if they haven't, like, without getting commission from us, if they do the deal, something like that,
then definitely suspicious. I
Is
mean,
it?
why would a
Right.
broker do deals without commission with us? There has to be something, right?
Correct.
I mean, there is no profit. If there is no profit motivation for him,
He won't do,
either he might, then why should he do that?
Correct.
So basically, like I said earlier, once before, the dealer should not get involved in processing, accounting, issuing information. All that has to be done by the back office. They can only transact from their place of work. But like I said, where your phones are recorded and in extraordinary circumstances, you may be able to do a deal outside, but you have to come back immediately and record that in your books. You basically, obviously, no deals or office or broker. That's obvious thing. Senior management approval to deal locations outside, like I just said, with specific approval. And again, if you're dealing outside normal hours, normal hours can be defined. There is no particular definition of normal hours. But if you take Sri Lanka, we say 8 to 5 o'clock. If you want to do a deal at 7 o'clock, because maybe you're dealing a US client or a UK client who wants to do a deal trade, there are outside dealing hours. We have pre-approval for that, or you can get one-off approval from your management to do a deal like that when you know you have to do something. Okay, dealers' own transactions must not go to another dealer. We should not be active in the market in their own transactions. So but this is what we call personal account dealing. So basically, if you have personal knowledge of a transaction, you should not use that knowledge basically insider trading. That's an obvious thing that you should not do. Most of this, what we talk about of ethical behavior, are practical stuff that you think on a normal day-to-day basis, you shouldn't be doing, so you shouldn't do it. So for example, if you have knowledge of a project that's going through a flow of transactions that are going through, you should not do it if there is a direct profit motivation for you. Or you should not, like the first point, get somebody else to do it on your behalf. Or you should not do it with through your wife or your mother, father, somebody like that. If you have knowledge, usually if you have inside information, you fall into an inside information register, which basically binds you to make sure that you are not dealing on that information. So here, bank must obtain and retain a copy of the dealer license. Sri Lanka doesn't have a dealing license for dealers. However, everybody who sits in the deal room has to have the ACI dealing code or the ACI dealing certificate or the operation certificate, or there's a certification issued by the Center for Banking Studies at Rajagiriya. That course, you are set for that course. That is effectively like a license, but other than that, there is no licensing requirement as such from Central Bank. Segregation of duties, like I mentioned, make sure you have the correct segregation so there is no conflict, and a secured and restricted dealing, meaning your dealing room has to be controlled physically by who can access it. Only certain people can get into the room and out. There's access control so that the information in the dealing room remains in the dealing room and there is no other, outsiders walking in and out of this.
particular question.
Yeah.
Does it require to CCTV camera in place inside the dealing room?
Well, I know one bank who does it, but it's
Okay.
not a requirement. It all depends on the compliance of that bank.
Correct. Okay.
It's all internal request as to how comfortable they are with the compliance structure. It can differ from bank to bank.
Okay.
So remuneration has to be linked to basically what the risk the bank, the client is, the dealers are taking, the profitability it is to the bank, and in terms of skill set, what kind of skill set we are looking for when we are looking at people. So remember, this is a high pressure job. Once you have taken on a position, you can sit on it overnight, and next day you come, you could have lost a lot of money. At the same time, you could have made a lot of money. So depending on the type of risk you're taking or willing to take, depending on the type of people that you want to do that, and the complexity of the positions that you carry in terms of risk management, then you will basically remunerate the person. Usually, most of the foreign banks or the global institutions would pay more emphasis to a higher variable pay, which is linked to the profitability of the deal in the past than it was to fixed pay. So, but that has changed now because of the bank's risk appetite after the global financial crisis coming down. There is more emphasis on lesser variable pay on profitability. Even if you make a lot of money, there is profit possibilities of your variable pay changing much are less. And even if, and I know certain instances where people have got paid more for actually highlighting bad conduct, meaning coming out and saying, look, I didn't do this transaction because I felt that it was not fair by a client, or it was not a good deal, it would have caused a market disruption. And the banks usually compensate people for not making money, but preventing a bad situation from happening as well now. So the remuneration of a dealer is usually managed by the treasurer and then the HR, and basically within the overall profitability of that room and the profitability of that particular dealer and the overall conduct of that particular person as well. Yeah, so that's again, other controls would be that the people who do the confirmations, etc., run independently. Reconciliation brokerage activity also is done by the back office, not by the dealing room, so that we know that we are not giving one broker more business than the other. Even if that's the case, there has to be reasons given for that separately. Not to reconciliation balances are given to front office by the back office. There are monthly reconciliations, there are daily reconciliations based on the amount, and any discrepancies are raised to the front office. Revaluations of positions are done by the middle office. The revaluation highlights any substantial trading losses, as we discussed. Do you know what mark to market remains talks about? What is mark to market? Mark to market is market to market, meaning you have borrowed money at 8%. Today's rate is 9%. The mark to market for that will be 8, 9. You compare what 9 against 8 is, you have a 1% loss for the remaining duration of the deposit. So that's your mark to market impact for that. If you have a 1% profit because the rates have gone down to, if you have a mark to profit there, if you have a mark to loss, if the rate has gone down to 7%, that's the mark to market loss. So mark to market will give you, based on the market rates that day, if you mark your position against the market rate, this is your overall loss or profit on your portfolio. The last point here all deal transactions should be recorded the same. That's very important. Not only on the same day, it should be recorded within a certain amount of time. So if you deal with a client and he agrees on a rate, within 15-20 minutes, the deal has to go into the system. Because if not, you're running market risk. The client has already confirmed the transaction. If you're not putting it and recording it in your primary risk management system, you are effectively leaving the bank open to risk. So you need to record it in a reasonable amount of time. Sometimes it could be half an hour, 20 minutes, 15 minutes. But the bank has to document as to what their reasonable account times, and the deal has to be put on the system before that. So all this is saying of making sure the person who is dealing and the person who is processing are two different people. Dealing room staff cannot have access to test keys because they shouldn't be able to process confirmations. They shouldn't be able to sign off on confirmations. They shouldn't be. They should be able to access the back office or front middle office processing systems. Third-party extreme care, meaning if you're paying your own client, that's fine. If you're paying a third party, what is the reason for the payment? Is there a linkage between the third party and other parts of the bank or client? There has to be some independent verification of that before third party payments are made.
So third party payment in the sense
So for example, if I'm buying dollars and sending it to say you and I are trading, if you say buy dollars and give it to me, I sell you dollars. You're the first party. You're the party beneficiary. If you say buy dollars and send it to Mr. Y, he's the third party. So we need to make sure the third party has businesses with you, and you are doing a valid transaction to him.
Okay.
And there is no connection, or there's more risk because you don't know why the purpose of the funds. It's more, I think, in line with also financial crime risk as well, to be honest. Yeah.
Okay.
So then audit trails, basically, you need to make sure that it's sufficient audit trails available so that in that third line of defense, the audit comes in, everything is well documented and there. The last point, no trading in news until adequate control, recording and reporting. That's a very important point because sometimes I find that banks want to introduce new products, but they think of it maybe from a profitability point of view only. They need to think of everything. How does this risk get recorded? How will we monitor this risk? How will we backtest to see whether it has been profitable enough? Is there a legal risk involved? Is there a compliance risk involved? That has to go through what we call a new product due diligence in our world. So to see that everything is okay, everything is in place, and we can go ahead and launch this product. There is a business case to be made, but there's also a case to say, look, these are the other aspects there. Do we have all those in place before new product can be launched? If not, the operational risk of that, the operational cost of that, everything could be very much more than the money we make out of the product as well.
So that previous slide you says that test key, can you elaborate more on that?
Oh yeah, so these test keys are what you use to make payments. It's like a code. So dealing room should not have test keys. Say if you are releasing a SWIFT payment, you have a code, right? Like correct, that. You should not. They should not have access to those systems or the keys, basically. Test keys meaning codes.
Okay. Then they should
so that
not,
they can process those transactions.
Correct.
So controls are both preventive and detective. So basically, like I said, one is to prevent. So sometimes you have limit set. If the dealer makes an error and puts the wrong amount, the system won't allow him to process it. That's preventive. But that depends on how good your system is to stop that from happening before it happens. Yeah. And detective is the next day to come back and say, okay, fine, this has happened. What do you do about it? Yeah. So you have the auditors who come in and check what the control functions have done and what the front office has done. And then you have the regulatory review by the regulator of the audit area. They come and speak to the control functions and front office, everything, but they mainly work with the audit guys to make sure that how they got comfortable around the whole thing. So this is basically one of the audit side of it. What they check basically, whether limits are in place, whether dealing positions were maintained, how it was maintained, what is the documentation around it, etc., etc. So if there are anything that is not in line, there will be an audit report that's generated. The audit report that's done will highlight where the limits have been breached, where there has been possible risk to the bank, and then where we can do better from whatever has been mentioned. It also touches on contingency plans. So they will also look at scenarios where not only will audit look at the current situation and say, oh, these have been done correctly, but these could be done better. It also looks at, look, if you have a situation like this, how would you handle it? Like contingency plans. So, for example, I had an auditor once who came and audited us, and he actually mentioned something like, if you have a big disruption, do you all have a contingency plan to manage your business? So we did, and we mentioned how we do it. So I was thinking about him the other day because one of the areas that he actually touched on was a pandemic. This is about 3 or 4 years ago. If you have a pandemic, how would you manage it? Now, that was not the case at that time when he asked me that question. Also, I was thinking to myself, very unlikely that will happen. But he did ask the question. And we had an answer about working from home, working from our contingency sites, and how we'll do it. But we really didn't have a full-scale answer because we've never gone through it. But now, after having gone through it for 3 months, I can give him a better answer how we'll do it.
Work from home, like every dealers are work from home on roster basis or something like that.
So what happens is, when it comes to why it was difficult for me to answer at that time is we have surveillance and stuff that we discussed just now. So when you're working from home, you don't have surveillance, right?
Correct.
You don't have surveillance. Your phone calls might not be recorded. So it's very difficult for a person in the front office dealing room to work from home.
Correct.
Or even from a contingency side, because you might not have all your equipment and everything there at that time to deal, right? But what happened was, when this whole pandemic started, bank had to change the way it does. So we had systems coming in, we had recording systems put in that would record my conversations even from home through the computer, basically, right? So we had new
office laptop.
Office laptop. Correct, exactly.
Okay.
It is not 100% because there is no physical surveillance. You're sitting in a room in your home, so there anybody can go in and out. That is there. So that is not the ideal procedure, but it was something contingent that the bank did to facilitate clients and make sure that there is no disruption to market activity, right? Okay. And it was recognized as that and documented as that, as an extraordinary event, not the normal course of business. Yeah. So that's the way we dealt with it. But if my guys work in the contingency side, it's fine. It covers all those requirements, but we don't have the same, abilities we have now on this basically.
Okay. Just a quick question, like, is it possible to install Bloomberg into a personal computer, or you need to have a separate server, something like that? Just, I don't know.
Personal computer for your personal use, is it?
No. When you're working at your office laptop, I don't know.
Everything is internet based. So there are Bloomberg platforms that you work on, but if you can even take Bloomberg on your BlackBerry or your Samsung, there's what we call Bloomberg on the move. But you can't deal on it. You can get information on it. But the dealing system
you can't
is
deal.
You can't deal on it. No.
Even Reuters, at the home you can do using Reuters.
You can. But I think you have a portable device where if you want to go to another device, you can go platform. Sorry for this. Another PC, you can log into that PC with that, and then I think off the net you can deal as well. It's called Bloomberg on the move, basically.
Okay. And okay.
Yes.
Just I don't know whether you can able to answer, like it's a bit confidential. I don't know. They just want to know, like, when it comes to Bloomberg, do you all your dealers have the Bloomberg license? No, few of them having the Bloomberg
No, it's
license.
not confidential, but all of them don't have, because not only to do with this thing, it's also cost, right? So
yes, that's why I'm asking. Yes.
Yeah. So what happens is the trading side, we might have one Bloomberg, one Reuters trading system. But the thing is, it all depends on how much of volume of business you're doing on that. But anything else is based on cost. So if one Bloomberg is sufficient for us to manage the business we have, it's fine. If we have increase in volume and whatever, then we might consider Bloomberg or Reuters. But that is a decision we make at that time based on our requirement and what we are willing to spend for that.
Correct. On the move Bloomberg, in the sense you can extract information, something like that, like you can view what are the changes.
Correct. Yeah.
Okay. And when it comes to FX all and all, you can do the online transaction as well, like deal you can do, like
FX all is a platform that most banks would use as a trading platform.
Yes, correct.
Where you can deal, but the settlements will be different depending on how it's done. But it is a way of locking in your rates. Yes.
Okay.
You have to take away the settlement side of it away from the actual booking of the rate, because ultimately in developed markets it's all the same. Once you do a transaction, it'll go through, and there is margin trading and all that happens, right? And accounts are set up only when you have balances in your account. But in control currency countries like ours, it's all linked to the underlying transactions and the limits in the bank and all those things. So you can do a trade, but it only settles if all those requirements are there, and that separately happens separately. Yeah. But online trading is different. Online trading means that you have accounts set up separately with all these counterparties, clearing houses, all that. And as soon as you do a trade, it can tell you whether you're making money or losing money or whatever it is. Basically.
Okay.
Any other questions? Okay. All right. This area was not too tough. I think you can go through it carefully. I will not be here next week onwards. I think Nishanta will be back with you all. I will rejoin you all, I believe, for the ALM part of the course again. I'm so sorry that we couldn't meet face to face. I hope we can do that soon. And I hope the sessions were useful for you all.
Yes, if any chance, like we want to get some clarification, how can we contact you?
Okay, what I would tell you is, if you could write email to the institute,
okay,
with any questions you have, and then, like I said, I'm anyway coming back for the next another session as well. If you think you need to revise or go through some of the sections we've done already or whatever it might be, we can consider it at that time. If it's a clarification I can give you over an email, I'll do that for you. But my advice would be to send it to the institute, let them sort of centralize it and then send it to me for so that I can write back to you.
Okay, thanks.
I asked the institute to send you the material that was already shared. I hope you have received it on soft copy as well.
Hard, that reading materials?
Yes.
Reading materials, first day we had the hard copy, but soft copy we didn't receive.
Okay, I will just remind you because I sent it out a few days ago and asked them to send it. Let's see. I'll remind them about that. Yeah. Okay. Thank you very much.